Can you confirm you can see me and hear me?
Good evening, Prof. We can hear you and see you.
Oh, that's good. That's good. That's good. Okay. Okay. So once again, I welcome all those who have made their affairs possible for them to be here for this August 2020 webinar forum. I personally tag this forum as our August meeting. You know, August meeting is for those who are August visitors. And you know what an August visitor is? Is an important visitor, a very important person. So all of you here who have made your affairs to be here, you are all very important personalities. And so because of how important you are to us, we have decided to take something that is very important as accountants. All of us are accountants, some are aspiring. That's good. Now we have a key topic we want to discuss about the IFRS. The topic for today is COVID-19, spotlighting key accounting standards for financial reporting. That is the theme we are going to be dissecting today. Able speaker who can 5 hours, he can do that non-stop. Okay? So we're going to give Mr. Ayome Ladoku our undivided attention as he takes up this topic. I repeat the topic again, COVID-19, spotlighting key accounting standards for financial reporting. I bet you it will be worth your while listening to him, pay him your rapt attention. Please note that all the questions that you have concerning the chat forum, we are going to handle them at the end of the forum. So as I give the microphone to Mr. Ayome Ladoku and take the back seat, I want you to give him the floor is open for you now.
Okay, good evening, everybody. You're all welcome to FCA August 2020 webinar forum. I want to confirm from my host if you can hear me very clearly, and you can also see my screen before we commence.
Good evening. I can hear you clearly and we can see your screen.
All right, thank you very much. Don't worry, the light will be restored very quickly. So I want to welcome everybody that has signed on to August 2020 FCA webinar series. And as my host has said, we are going to be looking at some key financial reporting standards that are actually coming to the spotlight because of the pandemic. That's COVID-19. I'm sure we're all aware of what is happening currently around the world. That's the coronavirus pandemic, and there are a lot of implications to the financial reporting. Okay, so that's what we are going to be looking into. So I'm quite aware that, Now I'm quite aware that some of us are already qualified as a chartered accountant. Some of us are also aspiring to be a chartered accountant, obviously, you're also preparing to write your exams. And some of us are also working as an accountant, and we are, looking at what would be the implication of some key accounting standards in the financial reporting. So it's going to be a 2-day webinar. So today we are going to start off by looking at some very key standards, so I can lay some foundation today, and obviously tomorrow we're going to, put an end to that. Okay, so you're all welcome once again. Focus is COVID-19. Spotlighting key accounting standards for financial reporting is a kind of a two-edged sword. Firstly, for people preparing for ICANN or ACC exams, and people that are also, working, or they're already qualified and they are working, and they might be interested in adding some knowledge to what they know before. Okay, so I'm pretty sure it's going to be a very interesting time together. So we have some key accounting standards we will be looking into. Okay, so let me quickly take us through webinar instructions. Participants are expected to be muted on both audio and video. We don't really need to see your face, okay? But in case you want us to see your face, maybe tomorrow after the end, we might decide to say, oh, okay, let's say hi. Okay, and on your audio too, ensure you are always muted so that we are not distracted by background noises. But obviously, it's only my video and my audio that will be, on during the period, okay? Then you're also allowed to use the chat button to ask questions. So if you are using your device, a phone device, you see a chat button over there, or if you are using your system, you also see a chat button. So in case you have any question at any point in time, kindly put it through the chat button. Okay. In case you're having technical difficulties, for example, maybe you cannot hear all of a sudden, there are two headlines that you can see on your screen. So kindly either you call them or you chat them up. They are going to, provide a very smooth and very fast assistance to you, so that you don't miss out. Okay, and we also expect that you are cordial and professional when using the chat button, to actually to either ask questions or to express your concerns. Okay, so we are all professionals, so no matter how angered you are, maybe because of the network issues and all of that, so just try to manage everything and try and be professionals. Okay, and I also expect that we listen attentively, even though you're going to have access to the video by Monday or Tuesday latest. But I would rather prefer that you listen attentively, because so that you can get those points as quick as you can. But then if you have something you needed to jot down, that won't be out of place. Okay, that will be out of place, so you can go ahead and do that. Okay, and I'm going to attend to all your questions at the end of the lectures. Okay, that is to ensure that we're able to manage our time. However, I might decide to have some break in between the lectures to also attend to your questions. So feel free to call us or chat your facilitator for questions and clarification, even outside normal lecture time. So maybe as it relates to exams or what you do in practice when it comes to accounting. Okay, so just feel free to always contact us. So you're all welcome once again. Okay. So let's move on. So I would like to meet you guys. Okay. So I really, the webinar is not the regular class lecture. So that's why you are seeing all of this, even though we are also aware that some of you actually sign up because you are preparing for ICANN exams. Most likely that will come around September, hopefully. Okay. So, but I would like to meet you. What's your name? Just tell me. So, like I said, I wish this is a physical webinar, but then because of the pandemic, this is the new normal. So what's your name? Although we have some of this information before, but that's nice. But if you can still do that within the chat button, what do you do? I'm actually interested in what you do at the moment. Are you a student? Do you work? Where do you work? Okay. Are you the chief accountant? So let me have those information. It's going to also influence my approach, to the webinar, okay? And what do you actually expect from the webinar? I want to see those feedback. So grab your keypads and go to the chat room and try to provide this information. So just do it in one chat. Your name, what you do at the moment, what are your expectations from the webinar, and something unique about you, okay? Sorry. So I'll be expecting that. As soon as you drop it, I'll go through them, and it's going to really influence my approach, okay? If I know that all of you guys are students, the way I will handle it will be quite different. If I know that I have a mixture of students and qualified accountants, the way I will also approach it is going to be different. So that's why I will need that information. So thank you very much. I think I'm seeing some information already. That's nice. Okay, so just tell me what you do at the moment, what do you expect from the webinar, and obviously something unique about you. So I'll be checking often. Okay, so you're all welcome once again. So the topic before us is COVID-19, spotlighting key accounting standards for financial reporting. Now, because of the pandemic, I think as of today, almost 20 million people, I think it's even more than 20 million now, that are infected with the virus throughout the world. Okay, so and the problem with COVID or coronavirus was two things. Number one is the transmission rate is very fast. People really get infected as fast as possible. And number two is it also have a high mortality rate. Okay, people also they don't really recover as soon as like that. So the death rate is also very high. Okay, viruses that we have experienced in the past is either of the two. Is either it has low transmission rate and high death rate or mortality rate, or it has high transmission rate or low death rate. Okay, but COVID-19 has a combination of the two, and there are a lot of implications to financial reporting. All of a sudden, some standards that were looking as if they are dead before, just came to the spotlight. For example, IS-10 event after the reporting period. COVID came around December 2019, and all of a sudden, in January 2020, it spread, almost throughout the world. Okay, so and there were questions whether COVID should be treated as a non-adjusting event or an adjusting event. So we're going to be looking at IS-10, as it were, fully today. So we also see what is happening around that. And there are also concerns around impairment of assets. Okay, because of COVID, all of a sudden the what or the value of some assets, skyrocketed, some went up, some, came down significantly. Okay, so it's having a lot of implications to financial reporting. And because in some industry or some sectors like the airlines, the tourist industry, and the likes, because of the lockdown, and the fear of contracting the virus, their businesses really went down. So there could be some pressures in terms of revenue recognition. So you can see the ripple effect, of the pandemic around those areas. So we'll be looking at all of this, but obviously we may not really cover all the syllabus because the webinar is to open our eyes, to all these key accounting standards. And I'm pretty sure if you are writing account exams or HCCA, this will be the central focal point, from the examiner. Okay. We also try to see, the kind of questions you might face in the exams and the kind of scenarios you might also see, in the practical sense. Okay. So thank you very much for people that are responding to my request, even though everybody is saying their names. Gabriel Vivian, Mide, Bangboche, Bisara Jakai, okay. Mr. Kongbe Online Car. Then I have Okechukwu Kaha. You work as an accountant in aviation sector. Okay, that's fantastic. And I'm also an ICANN student. I want to have depth knowledge of IFRS. That's brilliant. Okay, so that's exactly what I'm expecting. So people that have mentioned an email here, can you quickly tell us what you do at the moment? And so let me have an idea. so that it will help me, in my approach. So I've seen one vital information, someone that works in the aviation sector and as an accountant. That's brilliant. And the expectation is to have in-depth knowledge of IFRS. So obviously, I want to believe you're going to see that. Okay, so we'll try our best. The engineer Atta, the student of ICANN, you head internal audit department of the Chartered Institute of Taxation of Nigeria. Wow, that's fantastic. I expect to have the topic of the webinar explain the effect of COVID-19 on IFRS. That's fantastic. Oh, so we have a head of internal audit with what's it called? CIT here. Oh, that's brilliant. Okay, that's nice. That's nice. So my brain is is working now because I'm having a fair idea of my participant. That's brilliant. We also have Mr. Inkak. Okay, ICANN student, Ed Reconciliation and HMO. Okay, that should be Health Management Organization, if I'm not mistaken. That's fantastic. Okay, everybody is welcome. So as soon as you can, please put up your information over there. I will check it as we move on. It's going to really have an impact on what I do here. Now, the first standard before us is IS 36, Impairment of Assets. Okay, but before we go into this standard, let me quickly explain or give you some background. Okay, now you may be wondering, most of these things I'm going to say now, you won't see it anywhere, okay, on paper or in a textbooks or whatever, okay. But let me quickly do this before we commence. Now, we have IFRS, we have IAS, okay. But let me go back to the background. Before IFRS, what we have is IAS and SAS, okay. SAS is adopted in Nigeria, or it's being used in Nigeria, and it's set up by the NASB, that's the Nigerian Accounting Standard Board. SAS is Statement of Accounting Standards, okay? That's what Nigeria use. So anytime you hear the word NGAP, that's Nigerian GAAP, okay? GAAP is generally accepted accounting principles. Then you think of SAS, okay? So obviously, before now, what Nigeria applies is SAS and IAS, okay? And IAS is International Accounting Standard, set up by the IASB, that's the International Accounting Standard Board, okay? Now, anytime a Nigerian company is applying SAS and IAS, and there are conflicts between SAS and IAS, SAS will prevail, okay? Because it's assumed that SAS has taken into account the Nigerian environment, okay? So SAS is going to prevail. Now, at some point, there were convergence around the world that there should be uniform accounting reporting, okay? Now, the whole idea is because, for example, I have a company situated in Nigeria that applies SAS, then as a subsidiary company in the UK or in the US, for example, in the US, they have what we call the US GAAP, okay? So there's always a disparity, in the treatment of accounting standard or how those information are being treated in the financial. So, it's not really easy. Okay, so that was the reason, one of the reasons for the convergence around the world. And when the convergence was done, they now came up with what we call IFRS, and that is the International Financial Reporting Standard. Okay, and it's a very big project because they needed to consider countries' gap. That's the national gap, cultural, a lot of things before they were able to come up with IFRS. Okay. Now, when they come up with IFRS, they start preaching it to, countries of the world. Okay. Now, countries began to adopt IFRS. So, in Nigeria, IFRS was adopted in 2012. Three-phase adoption. Okay. Now, the first phase, which was the phase one, happened in 2012, phase two in 2013, and phase three in 2014. So what it means is every company in Nigeria, as we speak, has already adopted IFRS, even though it was not made compulsory for the private sector. But obviously, when IFRS is the new thing, so what will your company be doing? So most private companies, all the private companies, they also zoom into action by adopting IFRS, which is set up by the IASB, International Accounting Standard Board. Okay, but in Nigeria, as we speak, some of the function of the NASB, that's the Nigerian Accounting Standard Board, has been taken over by the IFRCN, that's the International Financial Reporting Council of Nigeria. Okay, for example, they also manage the aspect of corporate governance, which was previously managed by the SEC code, that's Securities and Exchange Commission. Okay, but this is what I want to really bring out here. So now, when Nigeria adopted IFRS, so what it means is SAS is gone. Okay, that's the statement of accounting standards. Okay, but there were 3 standards that were not found in IFRS, but they were in SAS. There are 3 of them. One is SAS 14. It deals with the oil and gas industry. That's the downstream sector of the industry. And the second one is SAS 17. Okay, it also deals with the oil and gas, but the upper stream or the upstream industry. Okay, and the last one is SAS 25 that deals with telecommunication. Okay, so those 3 standards. Can I say that again? SAS 14, that's oil and gas. That's the what's it called? The lower stream, the downstream industry. Okay, and we have SAS. What's it called again? 17. Okay, that's the upstream industry of the oil and gas, and SAS. What's it called? 25. That's the telecommunication. Okay, I think I remember the last one. I think there are 4. That should be is the SAS 18. That's the gap, the SAS for not-for-profit making organizations. Okay, yeah. So making 4. They were not found in IFRS. So Nigeria still maintains those 4 SASs. Okay, so that's what you need to understand. And as we speak, all over the world, every country has adopted IFRS, except the United States of America. They still maintain the US GAAP. And the whole idea behind that was because of the corporate scandal that happened in 2000 that involves Heron. Okay, Heron, the WorldCom, even here, the Cadre 92 and all of that. So because of that, they refused to adopt IFRS because IFRS is principles-based accounting system. Okay, whereas the US GAAP is a rules-based accounting system. That means it's a matter of the law. You just have to follow the law in treating some accounting information. However, in IFRS, it's principles-based. And when you say IFRS is principles-based, it simply means 3 things. It involves judgment. Okay, that sometimes you need to use your judgment to prefer treat the right treatment to some certain transactions in the financial statement. Sometimes you use number 2 is estimation. You have to estimate. Okay, that's why we're going to be looking at the standard IS 8 accounting policy, changes in accounting estimate and errors. Okay, and I said judgments, estimate, and assumptions. Okay, so assumptions is number 3. So it's because it's principle based, it involves assumptions. And that's why if you look at ACCA and if you look at ICANN, there's something we call the ICANN Code of Ethics, okay? And the ACCA Code of Conduct or Ethics. So it's the same, right? Now, the whole idea is because IFRS is principles based, so they have to come up with those code of ethics like the being objective, objectivity, what's it called? Technical competence, professional behavior, confidentiality, and all of that. Okay, so that's the whole idea. So that when you are treating those financial information, you have to be objective. Okay, around that. So that means you are not biased. You have to display honesty. You have to be straightforward and all of that. Okay, and the both ICANN and ACC and ACAO, as it were, they also identify that professional accountants can be faced with ethical dilemma, in working as an accountant. For example, because of COVID-19, your management might, put you under serious pressure to recognize revenue, maybe because there were pressure from the shareholders. Okay, so what happens? Okay, then even for impairment of assets that we're going to check on shortly, obviously because of COVID-19, some asset value has, seriously been impaired, and that could be pressure not to recognize impairment losses so as to maintain certain level of reported profit. Okay, so those are the accounting implications when it comes to the impact of COVID-19 on financial reporting. Okay, so we're going to check that very shortly. Okay, so all you need to know is as we speak, all over the world, everybody has adopted IFRS, but the US is still that they have not yet adopted IFRS, so they still use the US GAAP. Okay, even though IFRS body is trying to convince the US, they were trying to look at the content of the US GAAP and see the ones they can take into IFRS. For example, income taxes. If you check IAS 12 and the corresponding standard in the US GAAP is the same. IFRS 13, the definition of fair value measurement under IFRS 13, if you check the US GAAP, is also the same. Okay, now what's now the difference between IFRS and SCS as I close that session? Okay, IFRS is International Financial Reporting Standard, and SCS IAS is International Accounting Standard. So you wonder that some standard they are called IAS and some are also called IFRS. So why? Okay, now for example, we have IFRS 15, revenue from contract with customers. We have IFRS 5, that is asset held for sale and discontinued operations. We have IAS as well, IAS 41 agriculture, IAS 36 impairment of assets, IAS 38 that's intangible asset, IFRS 9. So why? Okay, so let me bring your mind back. I said earlier that before now, what we have was IAS and SAS in Nigeria. Okay, so IFRS came. Now, when IFRS came, the first standard that was issued was IFRS 1, first time adoption of IFRS, because every company at that time needed to adopt IFRS for the first time. So IFRS 1 provide guidance on the ways to or the approach in adopting IFRS for the first time. Okay, so that's the whole idea with IFRS 1. Now, every other IFRS that were issued, now you have to be with me here. Okay, every other IFRS that were issued is in two ways. It's either it's a new standard entirely. So what it means is, if a new standard is coming on board, it will not come under IAS. It will come under IFRS. Okay. Now, if an amendment is done to an existing standard, for example, an amendment was done on IAS 39 financial instrument, so it becomes IFRS 9 financial instrument. Okay. An amendment was done on IAS 18 revenue. Okay. So it superseded both IAS 18 and IAS 11. That's IFRS 15. Can you see now? An amendment was also done on IAS 17 leases. So it was superseded by IFRS 16 leases. Okay. So whenever an amendment is done to a standard that has IAS, it's going to be changed to IFRS. And whenever a new standard is issued, that means that standard did not exist before now. Okay, it will become IFRS. So what it means is, in the next 10 to 15 years, we may not have IAS again. Once they make an amendment, they will change the number immediately and they will ascribe IFRS. But so all the IAS that we are seeing now, what it means is, since the commencement or the adoption of IFRS or the introduction of IFRS, they have not been amended. Okay, so that's why we still have IAS 36 impairment of assets, IAS 2 inventory, IAS 19 employee benefit, IAS 21 effect of changes in foreign exchange rates. Okay, so that's why you still have what's it called, IAS. I didn't plan to do this, but because I was seeing your background and all of that, and somebody also made a comment that wanted to have deeper understanding of IFRS, so that's why I quickly said, let me do that. I said, when I was seeing your information, my brain or my brain was working, so that it's going to really impact on my what's it called, my approach to the lecture. Okay. Okay. Mr. Shafi Ahmad, you cannot hear. Can you hear now? Okay. Oh, okay. You should be able to hear now. All right. Thank you. I think they are attended to you. Okay. Vivian, work as a financial accountant, assistant. Okay, financial accountant assistant. Okay, working with aviation too. Planning to write my account exams. I'm expecting to also have in-depth knowledge of IFRS. Okay. Ino Hansen, a student of ICANN, budget and payroll, power generation company. I want to know the standard that will come out of the. Oh, that's fantastic. Okay, you want to know the standard that will come out of the exam? Okay. Okay, don't worry. Let's ICANN fix the dates. Okay. Well, once they fix the date for the exams, so the next thing is I'm going to find out whether they will retain the previous questions for March. If they are going to retain it, so obviously we can you know as what will I say now? What will come out. Okay, so don't worry, we are together. Okay. Fatima Bangoshe, and I'm an ICANN student. I work as an accountant in Lagos State Government. Okay, I'm expecting to have deeper knowledge of IFRS as I prepare for the upcoming exams. Oh, okay. I think most likely most of us we are preparing for exams. Currently, ICANN student not working. That's side that. Okay, I expect the webinar to help me improve my knowledge of IFRS and COVID-19 impact. So I want to believe my sharp introduction should have given some insight on what to expect, right? Okay. Shall we please restart my device? And I can't still hear the lecture. Oh, you can't still hear the lecture, Mr. Shafiu Ahmad. My host, please can you help me to attend to him? Okay, I think he's been able to do that. Okay, that's fine. Okay, so welcome. We have not really missed anything, so we are starting right away. Okay, so we'll be able to see the differences between IFRS and what's it called, IAS. Okay, so take that to the bank, right? Okay, now so let's look at IAS 36, impairment of assets. Okay, impairment of assets. So I'm going to approach it in two ways. We relate it back to COVID-19. We relate it back to what's it called? Your exams. We also relate it back to work experience. Okay, so there's so many things I'm going to say that you might need to jot down, but make sure you listen. Okay, so when you say impairment, what is that supposed to mean? So this is my foundation. I'm going to be a little bit slow here, but once you're able to get this, it will be easier for me to put every other standard on their foundation. Okay, so just open your mind. Whatever you are doing, you are cooking, you are watching TV, or you are doing any other thing, just put me on loudspeaker and listen. You are going to really get it. I believe in something. Once you understand the principle, you can approach any question. And once you also understand the principle, anything you see in practice, I've seen some head of accounts here, head of internal audits, you're also trying to audit those accounts, okay? So once you understand the principle, then you are good to go, okay? So it's not really about the questions per se, it's about the principle. Then when you see questions, how do you approach it? I'm going to be showing you, okay? So let's start. Well, when you say impairment, what does that mean? Okay, I'm going to also look at depreciation. So what's the difference between depreciation and impairment? Okay, so now impairment is economic reduction in the value of an asset. Okay, economic reduction in the value of an asset. Now I'm coming back there. Now, and we have impairment loss. I'm still coming back there, right? Now let me quickly look at depreciation, because there's a difference between depreciation and impairment. Okay, now depreciation is a systematic allocation of depreciable amount on the cost or the value of an asset. Okay, systematic allocation of depreciable amount. Now, what is depreciable amount? When you buy an asset, you calculate the depreciation. So how do you calculate the depreciation? You can use a straight line method, or reduce the balance method, or sum of the years digit, depending on your company's policy. But obviously, what is common is straight line method. Maybe sometimes you can see reduce the balance. Even in your exams, most likely you're going to see straight line method. Okay. Now, how do you go about that? Say the formula to get my depreciable amount, is cost minus residual value over a number of years. Okay. I'm sure you should be able to. You should be familiar with that. So when you say cost of the asset minus residual value is also called salvage value or scrap value. Okay, so because it's a webinar, we are not really doing bookish things much like that, even though we have I can stay here. So let me explain that concept. Why are we removing the residual value? Okay. Now, the essence of depreciation is because of usage. Okay. So when I buy this calculator, for example, is very new. Okay. I needed to depreciate. That means I need to reduce the cost or the value, systematically over the lifespan of the calculator. Okay, so why am I doing that? It's because I'm using it. Okay, that's usage. Number two, because of wear and tear. So because I use it, so you can't expect the value to be the same in the market because it's no longer new. Okay, number three, because of obsolescence. Okay, so if care is not taken, this type of calculator might become outdated in no time. Okay, so I need to depreciate. Why do I depreciate again? Now, because of passage of time. So that's the essence of depreciation. So why are we now removing scrap value or salvage value or residual value? It simply means I'm saying that if I buy this calculator in 2020 and I estimate that I'm going to use it for the next 3 years, for example, and I'm saying at the end of 3 years, I'm going to, I can still sell this calculator for 5,000 naira. Let's assume I bought it at 20,000 naira. So I'm saying at the end of the year, or at the end of the third year, the calculator will worth 5,000. That is what we call the residual value, okay? Or salvage value, okay? Or scrap value. Okay, so if it's going to worth 5,000, then I don't need to depreciate that worth or that amount or that value. I can only depreciate the 15,000 because I bought it at 20,000, for example, and it will worth 5,000. That's why we say cost minus residual value over number of years. So I simply say 20,000 minus 15,000 over number of years. Okay, so that's the whole idea, and that cost is going to be an income to me, even though it's in the future. Okay, so I need to consider it now. That's it. That's how you get your depreciable amount. So when I now get the depreciable amount, that means the amount I'm going to use to reduce the value of the asset every year. Okay, so that's what we call depreciation. So what it means technically or effectively is that every year I'm going to depreciate an asset. That's it. Okay, I'm going to depreciate. Whether there is COVID-19 or there is no COVID-19, I'm going to depreciate. So that's why it's defined as systematic allocation of depreciable amount on the value of an asset. Okay, so that should be clear, right? Now, that's depreciation. Now, what is now impairment? We said impairment is economic reduction in the value of an asset. But before I still want to come back there, I will still come back. Now, we have something we call carrying amount of an asset. Okay, we have something we call carrying amount of an asset. So what is the carrying amount of an asset? Some of you will be used to this word net book value. That's what you are used to. That is used under SAS and IAS. Okay, but under IFRS, we use carrying amount. So if you use net book value, you are not still out of place. It's just like under IFRS, you now use statement of financial position. Before now we use what we call balance sheet. Okay. So, and in the old accounting, you also say profit or trading profit and loss account. But now what you do is a statement of profit or loss account and other comprehensive income. Okay. So that's what IFRS is bringing on board. Okay. Now, so what is my carrying amount? Now, be with me here so that you don't struggle when we get to questions. Okay. Carrying amount of an asset, like I said, also known as the net book value, is the amount at which an asset is recognized on the financial statement after deducting accumulated depreciation and accumulated impairment losses. Okay. Now, when you pick up a financial statement of your company, for example, and they say PPE, that's property, plant, and equipment, is let's say 200,000, for example. That 200,000 you are seeing on the face of the financial statement is the carrying amount of that asset. That's it, or you call it carrying value. Okay, it's the same, right? Okay, so that's the carrying amount. Now, that 200,000 you are seeing there, it simply means they have removed accumulated depreciation. When you say accumulated depreciation, that means from the year of purchase to that time, to that point in time that the balance sheet or the financial position was being prepared, okay? So that means if I buy an asset in 2018, January 1, 2018, and I carry the asset at 200,000 at December 31, 2019, okay, I would have removed the accumulated depreciation. That means if I didn't charge depreciation in 2018, I didn't charge in 2019. So once it's more than 1 year, that's why we call it accumulated depreciation and accumulated impairment losses if there is any impairment, okay? Now, when I remove it from the value or the cost of the asset, what I have left is what is called carrying amount, okay? Now, be with me here. We now said impairment is economic reduction in the value of an asset. Now, what does that mean? What it means is this. If, for example, the carrying value or the carrying amount of my asset is 200,000, like we just said now, okay, it's 200,000. When I look at the economic value of the asset, okay, you know, the 200,000 is, that's why they call it net book value. That is on the book, okay? Now, what is the economic reality? What is really the value of the asset if I want to sell? Okay, I will now look at the market value. Okay, so when I look at the market value, how much is the market value of this same asset saying? So let me go back to my calculator and use it as an example. I'm trying to be as practical as possible so that you understand, right? Now, when I've calculated the I accumulated depreciation, impairment losses, and all of that, I've deducted from the cost or the value of the asset, and what I have left was 200,000, for example, right? And I look at, okay, this 200,000 in the book. How much does this calculator worth in reality? Okay, now I now look at the market value. If I decide to sell the calculator, how much will I sell? Okay, so when I look at the market value, the calculator worth 150,000, okay, in the market, even though I'm not selling. I'm not really selling. I'm just trying to estimate the market value, okay? Now it's worth 150,000. So what does that supposed to mean? That means the asset has suffered impairment, and impairment is economic reduction in the value of an asset. Can you see the point now? So when I go into the market and I look at it and it's saying 150, that is the economic reality of the asset. However, I'm carrying it at 200,000 in my books. Now, the objective of IS 36, impairment of assets, is to ensure that assets are not carried at more than their recoverable amount. That's what we call substance over form. Okay. Are you getting the point? Are you getting the point, right? Okay, so I want to believe you are getting the point. So I'm trying to be as practical as possible. Okay, now, so when I have the carrying amount at 200,000 and I look at the recoverable amount, recover, when I want to recover the asset, that means I want to sell. How much does it worth? Okay, it's 150. Then the asset is impaired, right? Now, what is recoverable amount? So how do I estimate my recoverable amount? Now, be with me here. Like I will always tell my students, you know, in the physical class and even in the online class that we've been running since May, okay, I will say this is your first national anthem, and I have reasons, and I have the principle that you need to learn, okay? Recoverable amount of an asset is measured at the higher of fair value, less cost to sell, and value in use, okay? Let me say that again. The recoverable amount of an asset is measured at the higher of fair value, less cost to sell, and value in use. So let me explain. When you want to estimate or measure the recoverable amount of an asset, so what do? You look at two things. What is the fair value of the asset? Okay, so my calculator, for example, has been the center of our illustration, right? Now, what is the fair value? So the fair value is, because I'm assuming I want to sell the asset, even though I'm not selling. That's what entities does, okay? And it is done at the end of the reporting period. Okay, so I want to sell this calculator. What is the fair value? So when you hear the word fair value, just think of market value, even though there are so many you have three methods of estimating the fair value of an asset, but we are not looking at IFRS 13 now, right? Okay, but when anytime you say fair value, think of market value. Okay, now be with me here. The examiner, if you are writing corporate reporting, for example, don't expect the examiner to always say fair value. Okay, if you are writing financial reporting, that's in the skills level, yeah, you can, the examiner can go ahead and say fair value. Okay, but if you are writing corporate reporting, don't expect them to always, put it straight for you like that. So what will they say? They will say if the entity decide to sell the asset, and they will give you the figure. Okay, so that is the fair value. So when we decide to sell, okay, instead of them to say the fair value of the asset is let's say 300,000, for example. Okay, they can say if the entity decides to sell the asset, it will be sold at 300,000. So that is the fair value. Okay, now what is cost to sell? Cost to sell is, for example, this is my calculator. I needed to sell it, but before I can sell it, I need to fix some of the key parts because they're not really fine again, working well. Okay, so the cost I'm going to incur before I can make that sale. Okay, or maybe I needed to incur some transportation cost that would have been avoided if I'm not selling it. Okay, so that means that cost has to be directly attributable in selling the asset. Okay, that's what I mean by cost to sell. So when you look at the fair value, let's say it's 500,000, and how much do I want to sell? How much is the cost to sell? Let's say it's 50,000. Now say 500,000 minus 50,000, I have 450,000. So that is my fair value less cost to sell. Sometimes they can say cost of disposal is the same thing. Be with me here. Now, anytime you hear me say be with me here, if you carry your spoon, you want to eat like this, just stop and listen. Okay? Okay? Because I wanted to say something differently from what I've been saying, right? Now, the examiner may say that the net selling price of the asset is 450,000. Once the examiner said net selling price, it simply means the examiner has calculated it for you. Okay, they have calculated fair value less cost to sell. So you don't need to start running up and down and say, where is the cost of disposal now? Yeah, this question is not correct. No, it's actually correct because the examiner has said net selling price. Okay, so that's it. Now, we said recoverable amount is the higher of fair value less cost to sell and value in use. Can you remember? So I've explained value in use. You're assuming that we want to sell the asset, right? Now, for the value in use, I've explained fair value less cost to sell, right? Now, so for the value in use, now from the word value in use, that means if I continue to use the asset, how much will it worth? And how do I know how much the asset will worth? What will be the future cash flows that the asset is going to generate? Okay, that's what I mean by value in use. So when you look at the value in use of that asset, okay, IAS 36 now says, it's the future cash flows. You have to discount to present value. Okay, so you have to discount to present value. So how do you do that? Remember your formula: 1 plus R raised power minus N. Okay, and multiply by those figures. So the examiner can give you up to 1 to 3 years. So you have to discount to present value. In practice, the IAS 36 specifically says that you should not estimate more than 5 years. Okay, because of conditions in the economy that are largely unpredictable. So you can imagine a company that has estimated 5-year cash flows in 2018. Okay, they said in 2018 they are going to make this amount of money in 2019, in 2020, in 2021. You can see what happened now. COVID-19 would have greatly impacted on those cash flows projections. That's why 36 says don't do more than 5 years, okay? Because it's quite reasonable. But for your exams, the examiner may not really give you up to 5 years. Maybe maximum that questions I've seen so far, maybe maximum they give you 3 years, okay? But there could be some technicalities around those questions. So I'm going to show you. Maybe they will now tell you maybe from year 5 or year 3, it will grow by a certain percentage. Okay, so how do you go about that? So we're going to go see some of that when we start solving questions. So, but the whole idea is those future cash flows must be discounted to present value. Okay, you now compare the value in use and the fair value less cost to sell. The higher of the two is your recoverable amount. Okay, because the recoverable amount of an asset is the higher of fair value less cost to sell and value in use. Okay, now when you now get the higher of the two, now if the examiner did not give me value in use information, automatically my fair value less cost to sell is my what's it called? It's my recoverable amount. If the examiner did not give me information on fair value less cost to sell, automatically my value in use is my recoverable amount. But if the examiner gives me the two information, I needed to calculate them. The higher of the two will be my recoverable amount. I will now take the recoverable amount. I will now compare with the carrying value or the carrying amount of that asset. Once my recoverable amount is lower than the carrying value or the carrying amount of that asset, then the asset is said to be impaired. Okay, and once it's impaired, I-36 says the asset must be written down to its recoverable amount. So what it means is, if the asset value is 500,000, and when I estimate my recoverable amount is 350,000, for example, I have to write it down to 350,000 by passing an accounting entry. So what do? What will I do now? Okay, so what do? You have to write it down. Simply debit your POL account and credit the asset. Now, the difference between the carrying amount and the recoverable amount of an asset is what we call impairment loss. Okay, it's what we call impairment loss. So, an impairment loss of an asset is the amount at which the carrying amount of an asset exceeds its recoverable amount. So, if my carrying amount is 500,000 and my recoverable amount is 350,000, the difference between the two, which is a 150,000, is my impairment loss. So where will I take the impairment loss to? I will take it straight into my profit or loss account. I will write it off as an expense, and I call it impairment loss of an asset. Okay, I write it off by debiting POL account and crediting the asset. Okay, if you're having issues with debit and credit issue, okay, for example, if I debit an asset, what do I do? Or did it increase, or is it decreased? Okay, if I credit equity, is it going up or coming down? If I debit cost of sales, if you're having issues around that area, that's not a problem. Just chat me up. I'll send you a simple simple chart or format, for you to learn that. Okay, so it's not a sin. Okay, so don't be shy around that. Okay, but when you debit expenses, you are increasing your expenses, and when you credit an asset, you are reducing the value of the asset. Okay, so to learn other ones, I may not be able to do that here. So, but in case you don't really understand that concept, just chat me. Okay, so I'm going to take you through that. Okay, now, so that's what you do around that area. Okay, so I want to believe you are following. Okay, I think I'm seeing some questions here. Okay, somebody saying how about market value is more than the kind amount, so what will we call this one? Okay, so please, sir, can you explain further on the value in use? I didn't really understand. Okay, so let me quickly do that. Now, on the other way around, that's what I was going to do, that your question. On the other way around, my carrying value or carrying amount is 500,000. Okay, so when I estimate the recoverable amount is 700,000. So what it means is the recoverable amount is higher than my carrying value. Okay, so on my paper, the asset worth 500,000, but in the economic reality, it's actually worth 700,000. I-36 says you have to ignore. Okay, you leave it at 500,000. Why? Because we are not doing evaluation of assets here. It's only when you are doing evaluation of assets under IAS 16 evaluation model, that's when you can revalue to its fair value. Okay, or you are doing that under IAS 40 investment property. You are using fair value model. That's when you can revalue to its fair value. But because I'm testing for impairment here, okay, so I don't revalue that asset. I just ignore. I will continue to carry it at 500,000. So let me quickly re-explain the value in use. Value in use is just a concept that says if I continue to use the asset, okay, I'm not selling. I'm just, the idea around recoverable amount is that we are trying to estimate. Okay, remember earlier on I said IFRS is principles based, and because it's principle based, it means it requires judgment, assumptions, and what? Estimation. Can you remember? So that means when an entity is doing estimate, you have to get information from the market. What will be your discount factor? What will be your basis of valuation? It requires significant judgment. Okay, so that's what they do. So what I'm just assuming, or if I statistic is saying, you assume that I want to continue to use the asset. You know, the asset you use in your company, you use them to generate money. That's cash flows. For example, let me use some of our people that are in the airline industry. Your aircraft, for example, you use it to generate cash flows, okay? And now you want to find out whether those aircraft has been impaired. So what do? You estimate their value in use. If I continue to use this asset into the future, what will be the value in use? How will you know that information? Based on past experience, okay? You use a combination of past experience and what the market is saying, okay? So you estimate the value in use for year 1, year 2, year 3. So because those value in use are in the future, statistics now says they must be discounted to present value. That means you also need to come up with your cost of capital, okay, or your discount factor, like you know, but it's actually called cost of capital, okay, maybe weighted average cost of capital, depending on the way you have been able to calculate that. There are so many ways you can use to calculate cost of capital. One of them is the capital asset pricing model. You can use CAPM, okay, but we are not doing all of that here. You do that when you do your, what's it called? Strategic financial management, okay? Now, so once you get your cost of capital, but every company has its own cost of capital, if you find that properly, right? Now, you now use it to discount those future cash flows to present value. So that will give you your value in use. You now compare with the fair value less cost to sell. The higher of the two is your recoverable amount, okay? So I want to believe that is clear now, okay? That is clear. That should be clear now, okay? All right, thank you. Okay, so let's move on. I've tried to, explain almost everything here. Now, remember we said the impairment loss is taken to profit or loss account. Abi? Yeah. So you are good to go around that area. Now, what happens if the asset has been previously revalued? So what does that supposed to mean? Now, last year, let's say in 2019, for example, when I was preparing my accounts, I revalued my assets. So what it means is I carry a particular asset. Let's say this is my calculator using what's it called, revaluation model. Okay. Now at December 2019, when I was estimating, doing my asset revaluation and all of that, I realized that as at that date, after accumulated depreciation and impairment losses, the value of the asset was let's say 500,000. Okay. But because I carry this asset using revaluation model. So revaluation model is the same thing as fair value, right? You look at the market value. It's just that IS 16 and IS 40, in order to differentiate between the two, IS 16 is saying revaluation model and IS 40 is saying fair value model, okay? Now, when you revalue an asset as per IS 16, you take it to other comprehensive income, okay? That's revaluation increase. It's taken to other comprehensive income. That means if my calculator is 500,000 and it's worth 700,000, that's the market value or the fair value. I revalue to its market value, okay? That means I will take it from 500,000 to 700,000. So what will be my accounting entry? I will simply debit the asset by 200,000 and credit other comprehensive income, okay? So that's what I do naturally. So that's what I do in 2019. Now in 2020, there is coronavirus pandemic, okay? Now the COVID-19, for example, has now badly impacted on the what's it called, on the value of my calculator. Okay, so my calculator that was 500,000 at the end of last year, which is 2019, but because I've been valued upward, is now 700,000. All of a sudden, because of the COVID-19, the value has now fallen into 400,000. Okay, do you understand the point now? It has fallen to 400,000 when I look at the market value or the recoverable amount. So what I-36 is now saying is this. Now, be with me here. Last year in 2019, when I revalue, I take it to OCI. So there's a revaluation reserve within my component of equity of 200,000. If you remember, now the asset has now suffered impairment because of COVID-19. Okay. Now, what do? Normally, impairment losses are taken to P&L account. But for me, and like most of the things I'm saying, you can't see it in any book. But when you understand those standards, you know the reason why they are treated that way. Now, what the standard is saying technically is this. It doesn't make economic sense to record impairment loss for an asset that has a revaluation balance in the OCI. When you pick up your financial statement, you see impairment loss in the, what's it called, in the profit or loss account. And when you look at the statement of financial position, you are seeing revaluation reserve that also relate to that particular asset. It doesn't make sense. So what the standard is now saying is this: if an asset that has been previously revalued now suffered impairment loss. So what it means is this: you will first take the impairment loss into the OCI by knocking that revaluation surplus or reserve to zero. If there is a balance, you now take it to P&L account. So let me give you figures to that. We are going to solve questions around that, okay, to understand better. So let me give you figures to that. You know, we said in December we have revalued to 700,000. So I have 200,000 in the OCI, okay. Now this year the value of this asset is now 400,000. That means that's falling from 700 to how much? 400. So I have impairment loss of 300,000. So what the standard is saying is this: instead of me taking the 300,000 into my profit or loss account, I say no, I will go first to my OCI by debiting the OCI. You know, I've credited it before, you know, because I have a balance of 200. So I cannot take the impairment more than the reserve that I have there. So that means out of the 300,000, I'll take 200, I will knock it to zero, okay? And the balance of the 100,000, I'll now take it to profit or loss account. And if I don't have any balance, that means I'm not charging anything into my profit or loss account. It's also possible that the impairment loss is lower than what I have in the OCI. So I can only debit to the extent of the availability of the impairment loss. So if the impairment loss is 150,000 and I have 200,000 there, that means I can only do 150,000. Okay, I can only reduce by 150,000. So that's the whole idea around IS 36. Okay, so that's the whole idea. Now, before I explain some other technicalities, there's not really more technicalities, but the practical ways in which the examiner, if you're writing ICANN or ECCA as well, can ask you the impact of COVID-19 or how can entities use IS 36 for earnings management. I'm going to explain that shortly. So before I do that, now, what I've just explained is what we call impairment test or impairment review. Now, the examiner can bring you on and ask you to explain what impairment test is or what is impairment review. Everything I just said is what is called impairment test or impairment review. Now you have to pardon me. Do you know why? If you notice, I'm not really, how will I say it now? I'm not really showing what I'm explaining on the screen, okay? Although everything I'm saying is there. I have the reason was because if I read from the screen, that is the way it inhibits my flow. You know, I may miss out some things that I needed to say that were not in those books, okay, or what the material you have with you. So that's why, so that I can really explain properly, okay. So that's why it's like that. So I don't really like some of you guys might be used to the way I teach. So I don't really like using the note to teach, okay. I prefer to produce it right from my head, but if you check what is there, they are absolutely the same, okay. Now, so but this is what I want to explain. Now, the whole idea is this: what we just did was what we call impairment test or impairment review. So in case you were asked in the exams to say what is impairment test or what is impairment review, then what do you tell the examiner? Then you tell the examiner by saying impairment test or impairment review is a procedure required by 36 to determine whether or not an asset is impaired. Then you go ahead by saying an asset is impaired when its carrying amount exceeds its recoverable amount. And the recoverable amount of an asset is the higher of fair value, less cost to sell, and value in use. That's what it means. Now, be with me here. Before I can carry out impairment test, now let me give you a classical example. Look at people that say some of us here that works in the aviation, okay, or look at Guinness Nigeria or First Bank. You know, they have so many assets. Or let me say GSK, you know, they have so many machines for production and all of that, okay. So the issue is this, and you have to estimate their recoverable amount at the balance sheet date. That means if I'm preparing an account for 2019, December 31, I needed to know their value at that date. So it's going to be cumbersome, okay, because I have so many assets. So how do I do that? IAS 36 now says before an entity or a company can test for impairment. Okay, testing for impairment simply means you are trying to see whether an asset has been impaired. There must be indicators of impairment. Okay, there must be indicators of impairment. So what it means is if there are no indicators of impairment, then I don't need to test for impairment. It will be assumed that the kind amount of those assets are not materially different from their what's it called, recoverable amount. That's the meaning. Okay, now the indicators of impairment are now divided into two. Number one is internal indicators and number two is external indicators. Okay, so if I don't see those indicators during the year or as at the reporting date, I don't need to test for impairment. So let's look at internal indicators. I'll just try to tell you one or two examples, then we move on. So you have everything in your note. Number one, there is an evidence of damage or obsolescence as per the asset. Okay, maybe during the year around October 2019, the asset was damaged maybe by fire, got part of the asset. Is a classical example of an indicator of impairment. So what it means is the worth of that asset might not be the same, so you might need to test for impairment. Okay, now the performance of the asset is worse than expected. Okay, an asset that used to produce let's say 500 cartons per hour is now struggling to produce 100 cartons per hour. Okay, so that means the performance is now getting worse. Okay, so that's another example of internal indicators. Okay, so if you have any of these, one of them is enough for you to test for impairment. Then for external indicators, one of them is sudden decline in asset capitalization or the value of an asset. Okay, number two or another of them is COVID-19 pandemic. Okay, so COVID-19 is a classical example of an external source of information that an asset might have been impaired. You know, because of COVID-19 as well, some assets value really went up as well. Okay, so because COVID is a double-edged sword, as you can see, some industry really profited in COVID-19. For example, number one of them is Zoom. Like this Zoom we are using now, Microsoft Teams and the likes. Okay, even the data company, the tech companies. You know, I think MTN the other day they triple what they made last year in the first quarter of the year. Okay, now because of COVID, right? But at the same time, some asset value also went down. For example, some stocks and shares. There were a lot of apprehensions around that. Okay, so that is a classical example of an external source of information. It could also be interest rate. Okay, so there are so many examples you can think of. Okay, now be with me here. Because of COVID-19, the examiner cannot bring you on. How can an entity use IAS 36 as earnings management? Okay, so the question is, what is earnings management? Earnings management is an artificial way of improving the reported profit of an entity. Okay, when you artificially try to improve your reported profit. So what it means is the profit you don't really make, you want to make your performance to appear as if you really made those profits. That's the meaning of earnings management. And the way you do that is by way of window dressing. That's number one. And you can also do what we call account engineering, or what we call creative accounting. Okay. So those are the two ways that you can use to manipulate your reported profit. So as an accountant, you needed to be aware of these ways, and you can only understand those ways if you understand accounting standard. So it's also having impact on accounting policy. So we're going to be seeing accounting policy tomorrow. Okay, so now what is window dressing? Window dressing is when you deliberately go against accounting standard. Okay, you recognize revenue when you have not sold goods, you raise invoices when customers have not placed an order. That's window dressing. You deliberately overstate the value of an asset. You deliberately understate your liabilities. Now, be with me here. Not all the time, an entity will want to improve their reported profit. Sometimes they may also decide to reduce their reported profit. It depends on the objective or what is what is at the back of the management, what they are trying to achieve. For example, if I'm running away from takeover, what's takeover? another company coming to buy up my company, or mergers and acquisition, I might decide to inflate my liabilities and reduce my profit, okay, so that to scare them away. And how can I do that? I can use that by way of provisioning. IS 37, provisions, contingent liabilities, and contingent assets. We're going to be seeing that as well, okay? So that's something we call big bat accounting. I reduce my profit in the year that I'm making sales, I'm making money, okay, by creating provision. And in the years I'm making losses, I try to reduce them back. Everything is a way of window dressing, and that's why we have those standards that give guidance on how it should be done. Okay, so how can an entity now use statistics? That's what I wanted to explain. Now I've explained window dressing, right? Normally when I want to explain window dressing, I would say it's a situation whereby you go to the market to buy cotton, then you take it to the tailor, they sew it for you, and you come to the house and now put it in your in your window blind. That's window dressing, okay? That's by the way, right? But that's not really window dressing now, but I'll explain, right? So that's the ways you can go about that. Now, for creative accounting, now window dressing is both unethical and it's illegal, okay? That's why as an accountant, you may not want to do that, okay? Because if you do that and you were caught, it's a serious offense. If you are a chartered accountant, your certificate might be withdrawn, okay? Now for but the issue is how many financial statements in Nigeria are actually clean, okay? So that's a question that you should answer, because all of you have told me that you're accountants in your work. Okay, we also have auditors here. Okay, now, so another issue is creative accounting. Creative accounting is unethical as well, but it's legal, okay? Now, from the word, or account engineering, from the word creative accounting, creative, you understood accounting standards. So you now capitalize on the loopholes of accounting standard. One of them is IAS 8. You can use policy change, okay? Change your policy because you want to either reduce your depreciation or increase your depreciation depending on what you are trying to achieve, okay? So that's trying to, capitalize on the loopholes of the accounting standard. And one of them is also IS 36. You can also capitalize on that, even though it could be a way of window dressing. Now, be with me here. We said whenever the kind amount of an asset exceeds its recoverable amount, that means the asset has been impaired. So because of COVID-19, for example, obviously my asset has been impaired, so it's expected that I should recognize impairment loss. But whenever I recognize impairment loss, it's affecting my performance. Are you aware? It's affecting my performance. Normally, that same asset would have been depreciated. And when you depreciate those assets, it goes into my profit or loss account. So what happened? My profit comes down, okay? Now, the same asset has now suffered impairment because of COVID. It's like a double blow in the financial statement, and my performance is really coming down. So in order for me to manage that area so that I don't recognize impairment, what do I do? So there is a question for you down there that says because of COVID-19 pandemic, it's expected that companies should recognize impairment losses. But all of a sudden, most financial statements, there is no impairment that we recognize. Why? Okay, now what do they do? Or how can entity use IS 36 to manipulate their reported profit? It's very simple. If you understand what I've explained earlier on, what it means is this. We needed to estimate our recoverable amount. So what it means is when I'm estimating my fair value less cost to sell and my value in use, I will decide to inflate them. That's it. I will inflate it to the extent that by the time I get the recoverable amount, it will be so higher than my carrying amount. Because I know that once my recoverable amount is higher than my carrying amount, obviously I cannot recognize impairment losses. So in the process of estimation, I decide to manipulate those figures so that they will be higher than my carrying amount. So that's the way entities, that means it's an ethical issue, right? Okay, so that's what they do in practice in order not to recognize impairment loss. So as an auditor, I think we have an auditor here. So you need to ask, your accountant to give you evidence of those estimations. Are they really reasonable? Are they really telling the truth? By the time you start asking for all those questions, then they are in trouble. They say, yeah, you know what you're doing. Okay. So that's the idea around that. Okay. All right, so let's move on. Let's see whether we can see some questions to solve. Now, okay, we said you can only carry out impairment tests if there are indicators of impairment. Okay, however, there are 5 classes of assets that must undergo impairment review, whether or not there are indications of impairment, which could be internal or external. We have 5 of them. Number 1, goodwill acquired in business combination. That's number 1. Okay, so if your company, you acquire another company maybe last year, last 2 years, every year, whether or not there are indicators of impairment, you must carry out impairment review on goodwill acquired in business combination. Number 2, intangible assets with indefinite useful life. Okay, intangible assets with indefinite useful life. As per IS 38, intangible assets with indefinite useful life are not amortized. Okay, but they are subject to annual impairment review. Now, when we say indefinite, it is not infinity. Okay, infinity means perpetuity. It means for life. But indefinite means, as of now, there is no limitation to the cash flows that the assets can generate. That's what I mean by indefinite useful life. Okay, so they don't normally, they are no normally depreciated as per S38. However, they must undergo annual impairment review. So that's number 2. Number 1 is goodwill acquired in business combination. Number 2 is intangible assets with indefinite useful life. Number 3 is asset classified as held for sale. We're going to see that standard very shortly. Okay, that's IFRS 5. And number 4 is assets bought with a view to resell. You buy some assets so that you can, sell them again. Okay, so that's number 4. And the number 5, the last one, is also intangible assets during their development stage. Okay, so that means I started to develop an asset during the year and I didn't finish it, finish the development at the end of the year. I must test for impairment. So those are the 5 classes of assets that must undergo impairment test or impairment review at the end of the reporting period, whether or not there are indicators of impairment. Every other asset that are not within that scope or that category, they can only be tested if there are indicators for impairment. Now, let me also explain this. I'm trying to be as practical as possible. I think about 3 years ago, I presented a IS36 at work to some managers, the senior managers, directors, and all of that. So I did a presentation on IS36. I remember in that slide, I said I mentioned the scope of IS36, and number 1 was land. Land was there, okay? Land, okay? So when I finished the presentation, and people were now asking questions, and one of them asked me a question. And you know that before that time, I've been teaching the accounting standards, and it has not even occurred to me the question that the person asked, and nobody has ever asked me that question. Okay, so what was the question? The guy said, you said land can be impaired, but what we know is that land used to appreciate. So how come land can be impaired? When he asked the question, my boss looked at my face. They were like, wow, what a question. And as at that time, it has not even occurred to me. Now, and I quickly said something. I said, it's not me that said it, it's the standard, okay? That says land is also within the scope of IS36. Now, but immediately he asked that question, the answer came to my head immediately. So that's why, as an ICANN student, or as an ACCA student preparing for exams, you don't need to cram. In this part of the world, we like cramming, doing crash courses and all of that. Once you understand, that is the end. That is, understand, just seek for that understanding. Once you understand it, even at work, you'll be like their, Bible now or Quran, you'll be the resource center. Everybody want to come and ask you questions, okay? And you try to put them through. But to get an understanding is never easy. And one of why you're on this platform today, okay? So that's why now when the guy asked me that question, so and I answered right. And when I answered, everybody just clapped. Now what I said was that You know, if you go to mining industry or you go to what's it called? All this extractive industry where they dig gold, oil rig, and all of that. Okay, so because of that kind of activity on those land, if you want to estimate those land after some years, it can never be the same. It might have suffered impairment. Okay, and that's the answer I gave to them, and everybody was like, "Wow, that's fantastic." Even though it's not me, you know, it's not written anywhere. It's just you sitting down and understanding the standard. Okay, so that's it. Okay, so let's look at this question. So we can move away from IS 36. You know, I've said I'll spend some time here, but subsequently I will not. You know. Okay, so let's look at this. Said an item of plant is included in the financial statement at the current amount of 350. The present value of future cash flows to operate the plant was 320,000. The plant sold for the net proceed of 275. Required is the item of plant impaired and so by how much? Now, in that requirement, I've already seen what they want to test, right? It said impaired. So I know now when I see that statement, or when I'm able to determine that the examiner is testing IS 36, then I need two things. Okay, I need two things. What do I need? Number one, I need information on carrying amount. Okay, and number two, recoverable amount. That's it. Any impairment test or impairment question that you want to solve when it relates to a non-current asset, you need two information. That's the principle. Okay, I need carrying amount and I need recoverable amount. And I go to the question, where is my carrying amount? It's going to tell me. That is automatic. Ask the questions, right? It's going to tell me. If the examiner did not give me carrying amount, that means I need to calculate it. Then I ask the question, where is my cost? And where is my, how do you want a useful life? Or how do you want me to depreciate so that I can get my carrying amount? It's as simple as that. Once I do that, then I ask the question again, where's the information on my recoverable amount? It's going to tell me, my recoverable amount, I'm looking for two things. Fair value less cost to sell and value in use. Then I move on. That's it. Because I know what I'm doing. So we go to this question now and they say, question, why is my carrying amount? It's going to tell me. He said, my carrying amount is 350,000. Can you see that? Oh, that's fantastic. I write it out. Then where is my recoverable amount? The first thing I needed to know is fair value less cost to sell. He said the plant could be sold for a net proceed of 275. Can you see? He has already calculated it for me. He did not give me separately. He did not give me separately to say this is the cost to sell and this is the fair value. He has said net proceed. It could be sold. Can you see? That's why I said don't always expect the examiner to say fair value. Okay, he said it could be sold for 275 because I needed to get my recoverable amount. Then I ask again, where is my value in use? He said the present value of the future cash flows. So it said present value. That means they have discounted it for me. I don't need to struggle. If they say future cash flows, that means they will give me the discount factor. But let's say in this question, the examiner still went ahead to give me discount factor. I will ignore. Why? Because it has said present value. It's only when you say future cash flows, that's when I need to discount. So it has said present value. So it has already done it for me. I will now say between 320 and 275, which one is the higher? Okay, obviously it's 320. So 320 is my recoverable amount. I will now compare with the current amount in my books, which is 350. Okay, so this asset is impaired. Why? Because the current amount of 350,000 is higher than 320,000. I needed to write it down. That's the 30,000. So how do I treat the 30,000 as how do I treat the 30,000? I will treat it as impairment loss in the profit or loss account. So that means I will say debit profit or loss account and credit the asset by 30,000. It's as simple as that. Okay, so that's very simple, right? Now, so let's look at this exercise again. Okay, I believe you are enjoying the class. Okay, or should we play some music before we continue? Let's continue. Now, on December 31, 20X1, an entity noticed that one of its item of plant and machinery is often left idle. On this date, the asset had a carrying amount of 500,000 and a fair value of 325,000. The estimated cost required to dispose the asset are 25,000. If the asset is not sold, the entity estimates that it will generate cash inflows of 200,000 in each of the next 2 years, the discount rate that reflects the risk specific to this asset is 10%. Required. Discuss the accounting treatment of the above in the financial statement for the year ended 31 December 2021. B, how would the answer in part A be different if there was a balance of 10,000 in the other comprehensive income or in the OCI relating to the prior evaluation of this specific asset? So I'm assuming I'm in an exam hall, okay? And I see this kind of question. In fact, I like to use this kind of question to teach. Why? Because if you look at the requirement, it said discuss the accounting treatment. So it did not tell me that according to IS 36, what will be the accounting treatment? You know, once you say according to IS 36, I know straight up that they are testing impairment, okay? So how will I know the standard that is being tested here? So I go back to the question. It said, an entity notice that their plan is usually, let hide. Okay, that's a kind amount of 500,000 fair value less cost to sell was given. They also gave me value in use. Obviously, the examiner wants me to find out whether this asset has been impaired. And I remember that I needed two things. Once I've discovered that this is IS 36, I needed information on my carrying amount, and I needed information on my what? Recoverable amount. It's as simple as that. And I ask a question. Question, where is my carrying amount? It's going to give you. That's how you analyze question. It said the carrying amount of the asset is 500,000. I write somewhere in my notes. And I ask the question again. I needed to compute my recoverable amount. I needed two components. Fair value less cost to sell and value in use. It's going to give me. It said my fair value is 325 and my cost to sell is 25,000. Can you see? That's the way you break down questions. Okay. So when I net it off, I have 300,000. Okay. Now the question: do you give me information on value in use? Is either the question says yes or it says no. If it says no, then I move on. Automatically, 300,000 is my recoverable amount. But here it's saying yes because it said if the asset is not sold. Can you see? The entity estimated that it will generate cash inflows of 200,000 for the next 2 years. Can you see? For each, he said each. If you say for the next 2 years, that means it's 200,000. But because I said each, that means in year 1 is 200,000. In year 2 is also 200,000. Okay. Then I ask again, since it's a future cash flow, it did not tell me that it is the present value. Okay. I needed to discount to present value. Then where is my discount factor? It's going to give me. Can you see now? It said it's 10%. That's it. You said it's 10%. So what do I do here? I will now say year 1, year 2. I'll write my cash flows out. 200,000, 200,000. Discount factor is 10%. I'll press my calculator. 1.1 because it's 10%. If you say, you should know that, right? 1 plus R, okay? R is the rate. Raised power minus N. N is the number of years. So for year 1, it will be 1.1 raised to power minus 1. I will get something like 0.909, okay? I will multiply by the 200,000 to get the present value, okay? Then in my year 2, I will say 1.1 is power minus 2, okay? I'll get something like 0.826, okay? I'll also multiply by 200,000. By the time I add it up, I will now find out, I will add it up to get my value in use. So I will compare the value in use with my fair value less cost to sell. You know, my fair value less cost to sell is 325 minus 25,000. That's 300,000. So the higher of the two. So by the time you do this, I think you have something like 347,000. Okay, and I have 300,000 here. So that means it's the 347,000 that is the higher of the two. That becomes my recoverable amount. I'll now say, hey, my recoverable amount, thank you. Now, are you higher or lower than my carrying amount? So what it means is, if I have this asset as carrying amount of 500,000 and my recoverable amount is 347,000, it simply means the asset has been impaired. Because I said earlier on that it doesn't make economic sense to carry assets at more than their recoverable amount. Because what that means is this: the asset in my book is 500,000. However, if I decide to sell the asset now, it's worth 347,000. So I need to write it down to 347,000. That's by 153,000 by debiting profit or loss account and crediting the asset. So that's the part A of that question. Then part B, he said, how will my answer in that place in part A be different? if there was a balance of 10,000 in the OCI, okay, that means last year this asset was previously revalued, and there was OCI figure, there was a revaluation reserve at 10,000. So what do? I will have to go first to the OCI and knock it to zero. Then the balance, I will now take it to P&L account. So if my impairment is 153,000, I'll first go to my OCI and take this 10,000 to zero by debiting OCI by that 10,000, okay? So out of 153,000, I've debited OCI by 10,000. So what do I have left? I have 143 left. I will now debit P&L account. But the whole 150,000, I will reduce the asset by that value. And that's the end of the question. So you can see here, you can see it here. Can you see? This is the present value we're saying, year one. You know, I like to explain those answers using those questions so that you understand. So you can check the solution at your leisure, okay? If what I've said is different from the solution, put it up on the chart. We'll take a look at that, but obviously it can never be different, okay? So when you say 200 multiplied by this, you have 182, and in year two, you have this. So how do we get 0.90? That's a 10% discount factor, okay? 1 plus R raised to power minus N, okay? So the same thing for year two. So we have 347, can you see? So 347 minus 500 will give you 153,000. So that's the accounting entry you are seeing here, okay? And in the part B of that question, you now have to go to OCI first. Can you see the 10,000 and the balance that you have, which is 143? You take it to P&L account and you credit the asset with the old impairment loss. It's very simple. It's very simple, right? Okay. I want to believe you enjoy that. Okay. So let's look at the last part of IAS 36, which is a cash generating unit. It's also very straightforward. Okay, I'll try to also break it down so that you can really understand. Now, be with me here. Okay, if you are listening to me, you should not be tired, because me, I'm not tired. I can talk till 12 midnight here, but I'll try to stop at 10, right? So I can go and sleep. Okay, now, cash generating unit. Okay, so what does it really mean? Okay, you know, what we just dealt with is one asset, okay? One single asset. But when you have some group of assets together that generate cash inflows that are largely independent of other assets, or for you to identify their cash flows, they have to be together, okay? So that's what we mean by cash generating unit. And it's defined by a smallest identifiable group of assets that generate cash inflows that are largely independent of other assets, okay? Now, the challenge here is if a cash generating unit is impaired, how do we go about that? You know, for a single asset, it's very simple, just like we did earlier on, right? Just go straight to the asset, debit the P&L, and credit the asset. But when you have 2, 3, 4, 5 assets together, that's what they call cash generating units, right? So how do we go about, you know, impairing that group of assets? So the impairment test or process is still the same. You look at the kind amount of the cash generating unit and the recoverable amount of the cash generating unit. So in any question, you will always be giving, you know, they may not give you the impairment loss, but you always be giving a kind amount and the what's it called, the recoverable amount. You will always be giving, okay? You always be giving. Now, but the issue now is how do we impair those group of assets? Now, be with me here. If you want to impair, IAS 36 gave us 3 procedures. Even though if you check textbooks, you're going to see 2 of them, okay? But when you check the way they are solved it, they apply 3, okay? They apply 3 principles. So here, I've tried to break it down so that you don't struggle around that area. So I've really seen students asking questions, how did they do the impairment on cash generating unit? Because what they read from those textbooks was actually different from what has been done, okay? Now, when you want to impair a cash generating unit, you just ask yourself these 3 questions, or you follow these 3 procedures. There is no 2 way to it, okay? You cannot start doing calculation that you like. You know, like how we always tell my students, it is accounting standards. So you don't solve questions the way you feel, okay? If you want to solve those questions, you go back to the manual. you have to go into the standard. Okay, so that's why even in practice, I see a lot of people, they call me, oh, we just did partitioning, we just did the renovation in our office, we don't know whether it should be expensed or it should be capitalized as an asset. Even though, as at the time they ask me those questions, I may not have a ready answers to them. So what I just tell them on phone, I'll just tell them, let's go back to the standard. Then we start looking at the requirement of the standard, okay? And before I finish that conversation, they already know the answer. So you don't do it the way you want. So if you don't want to have issues with tax authority, you don't want to have issues with external auditors, you just have to understand, okay? So once you understand, you're able to clean your books very well as an accountant, okay? Even as an internal auditor, okay? So when you talk, they respect you because they know that you know, okay? So when you want to impair a cash generating unit, you needed to follow 3 procedures. So you have to put them in your head. So if I wake you up tomorrow morning and I say, what is the recoverable amount of an asset? You should be able to recite it. The recoverable amount of an asset is the higher fair value, less cost to sell and value in use, okay? What are those assets that must be tested for impairment? Whether or not they are indicators of impairment, it should be flying in your head, okay? 1, goodwill acquired in business combination. 2, intangible assets with indefinite useful. Sorry. Oh, sorry. So I was trying to, I don't want the network to be disrupted. So sorry. Now, asset classified as held for sale, okay? What's it called? Asset bought with a view to resell, and the intangible asset during their development stage. So you should know them, okay? And this is the third thing you must know, okay? If I want to impair a cash generating unit, 3 procedures must be followed. Number 1, impair obviously impaired assets. I'm going to explain that, okay? Impair obviously impaired assets. Number 2, reduce goodwill to 0. And number 3, allocate impairment loss balance on other assets on pro rata basis. So in most textbooks, you're going to see the second 2 that I mentioned. They will say number 1, reduce goodwill to 0. And number 2, allocate impairment loss balance on other assets on pro rata basis. But if you look at the calculation, they have actually done number 1 that I just mentioned, impair obviously impaired assets. So I don't want you guys to struggle. So I've tried to, expatiate or elaborate or cited those 3 procedures that you need to follow is in your notes, okay? Like I said, I don't really like looking at those notes when I'm explaining, okay? So you can find it somewhere in your notes. So let me explain those 3 procedures. We said number 1, impair obviously impaired assets, right? So in your questions, they will tell you, okay? They just follow the instruction in the question. For example, the examiner can say a patent that has a kind amount of 1.5 million, for example, can only be sold at 1 million, okay? It's in a question. They will always tell you, okay? So what it means is, if a patent has kind amount of 1.5 million within a cash generating unit, but can only be sold for 1 million. So what does that mean? Common sense requires that the asset is impaired by 500,000 and it is obviously impaired. So I'll first go to that patent by writing it down to the market value, okay? Because don't forget, you can't write an asset down below its market value, okay? So if the market value is 1 million and I'm carrying it at 1.5, obviously it's impaired. So I will go there and I will impair, okay? I will now move to the second point, which is reduce goodwill to 0, okay? Because it's assumed that if a goodwill forms part of a cash generating unit, most likely it is a goodwill that has been impaired. So that's why the standard says, for prudence's sake, reduce goodwill to 0, okay? So you now go to goodwill. Let's say the kind amount of my goodwill is 100,000. I will write it off immediately from the impairment loss. Don't forget, you cannot write down more than the impairment loss. So what it means is, if I have, let's say I have 100,000 as impairment loss, okay? And I've already impaired 20,000 in the obviously impaired asset. That's my procedure 1. And I move to procedure 2. And the kind amount of goodwill is 100,000. But I have 80,000 left as my impairment loss because out of the 100, I have impaired 20. Okay, so that means I cannot write it to 0. It will have to remain 20. I can only write off 80 out of the 100 because I have 80,000 left. But you may not really see that in your exams, okay? You may not really see that in your exam, but in practice, it might be possible. So I go to Goodwill and I reduce it to 0 completely. So the balance that I have left, so let's assume, let me just give a figure. We're going to solve some questions now, but let me just give a figure so that you can conceptualize that. Let's assume I have 100,000 as my impairment loss, okay? I go to obviously impaired assets. I impaired by 20. Let's say it's the 20, that I needed to impair. Then I reduce goodwill to 0. Let's say my goodwill kind amount was 30,000. So I reduced to 0. So out of 100 impairment loss, I have impaired 50. So I have 50 left. Okay. I'll now go to other assets. So those other assets can be non-current assets. That should be non-current assets, right? So let's say I have 2 of them that is left that have not impaired. Okay. That's the top procedure. I will now allocate impairment loss balance on a pro rata basis. So that means I will share the 50 between the 2 that is remaining. So how do I do that? So let me just give you some figures. So let's assume that I have furnitures and fittings. I'm trying to write it down here so that I won't forget those figures, okay? And I have, let's say, plant that is remaining. So the kind amount of furniture, let me just assume figure is say 30,000, okay? No, let me say, yeah, it's 30,000. Yeah, it's okay. Okay, that's the kind amount of furniture and fittings. For my plant, it's 70. Okay, that's a kind amount. But I have impairment loss of 50 that I need to share within these 2. So what will I do? You simply add the kind amount together. So when I say 30 plus 70, I'm going to have 100. Okay, so for furniture and fittings, how do I now allocate? The kind amount is 30. I'll now say 30 over 100. How do I get the 100? I got the 100 by adding the kind amount of the 2 assets that is remaining together. Okay, it could be 5 assets that is remaining. It could be 3, it could be 4. Just add their kind amount together. Okay, so I'll now say the kind amount of that specific asset over the total kind amount of those assets multiplied by the impairment loss balance that is remaining. So you have to understand that, not the whole impairment. The impairment that is remaining after impairing, obviously impaired assets, and reducing goodwill to 0, okay? So which is 50 in this case. I'll now say 30 divided by 100 multiplied by 50. I will have a figure. So that will be the figure I'm going to use to impair that asset. Then for the second one, it will now be 70 divided by 100 multiplied by 50, okay? So that's how you go about that. And that's the end of a cash generating unit. It's very simple. So let's see a question to demonstrate what we have just said, okay? So let's look at this exercise 3. Let's look at this exercise 3. He said, Tinud has identified an impairment loss of 41 million. Can you see? They tell us immediately for one of its cash generating units. The kind amount of the unit asset was 150 million, whereas the unit recoverable amount was 109 million. Okay, so they gave us this. Now said the net selling price of the unit was insignificant, except for property which had a market value of 35 million. Okay, the net monetary asset will be realized in full. Required, how is the impairment loss allocated to the cash generating unit? How is impairment loss allocated to the asset within cash generating unit? So obviously, when the examiner is testing cash generating, you will always know. Okay, but let's assume that I was not given this 41 million. How will I know? I will simply say, what is the kind amount of this asset? It's going to tell me, okay, he said the kind amount is 150. What is the recoverable amount? Is 109. So if you remove 150 from 109, you're going to get 41 million. So I have business to do with the 41 million, which is impairment loss. So, and I remember my principle, or I remember my procedure. Number 1 is obviously impaired asset. So anytime you want to do a question or solve a question on cash generating unit, so what do? You have to write all the assets down. So you say assets, write them down. Goodwill, property, machinery, vehicles, patent, and net monetary assets. Then you now say carrying amount before impairment. So what are the carrying amounts? You have 13, 20, 49, 35, 14, and 19. Then you total it to be 150. That's you want to solve now, okay? Then your third column, you now have impairment loss, okay? You now, you write it like that. Then the last column, which is the fourth one, is asset, kind amount before impairment, impairment loss, then kind amount after impairment, okay? So that will be the last column you're going to do. There is no two way to it. That's the way you have to do it, okay? So when I write it out, I will now say, this question, my procedure 1, is there any asset that has been obviously impaired? You simply look at the question. What is the examiner saying? So here it said, the net selling price of the unit assets were insignificant, except for property, which had a market value of 35 million. Oh, fantastic. Market value has a, property has a market value of 35 million. Then I ask myself, now I ask myself, what is the carrying amount? Then I will go into the question. You know, I would have written it down as well in my answer script. So it said the carrying amount was 20 million or 20 million. Okay. However, the market value is 35 million. So the question is this: is the asset impaired? Can you answer that question? Is the asset impaired? Put it on the chart. Let me hear from you. I don't even know whether you're still listening to me. So let me be sure you guys are still there. Is the asset impaired? Can you please put it on the chart? Just answer yes or no, okay? Just answer yes or no. I'm waiting. I need 1, 2, 3 comments in the next 1 second. Okay, is the asset impaired? The current amount is 20 million. And the, what's it called? The fair value or the market value is 35. Oh, thank you, Mr. Olayinka, Mr. Busayo, Vivian, Chinwe. Oh, fantastic. Everybody said no. Oh, that means you are following me. That's brilliant. I'm very happy. Now, that means, what it simply means is I will not impair. Can you see the trick of the examiner? Because in first procedure, it said impair, obviously impaired asset. So that means in this question, no asset was obviously impaired. So since there's no asset that was obviously impaired, because the property that has a kind amount of 20 million actually worth 35 million. So I will move on. I will not do anything. You know, like I said earlier on, we are not doing evaluation here. Okay. I will now go to the second procedure, which is reduce goodwill to 0. So I go to goodwill. Goodwill, how much is it? It says 30 million. How much impairment loss do I have? I have 41, if you remember. Okay. I will now write to 0. So in my calculator, when I say 41 minus 13, I will have 28 left. Okay. So be with me here. Since I've reduced goodwill to 0, I'll go to the last procedure, which is allocate impairment loss balance to other assets on pro rata basis. So I needed to allocate the 28 million that is remaining to other assets. So when you look at your question, you know, you've already reduced goodwill to 0. You cannot impair property below its market value. So that is fine. So that means I have machinery, vehicles, patents, and then net monetary asset left. So I needed to allocate 28 million, you know, on all these assets. But be with me here. The examiner said something here. Said the net monetary assets will be realized in full. Okay. So what it means is this 19,000 will be realized in full. That means it's not impaired. That's the meaning. I will restate it the way it is. So that means when I'm prorating, I will not consider net monetary assets. So that's why you need to pay attention to details. However, be with me here. Let's assume that this statement was not there. Okay, let's assume that this statement was not there. Sorry, I'm trying to see if I can highlight that. Okay, now let's assume that the examiner did not make this statement. Okay, and they gave us net monetary assets. Now be with me here. Anything that involves financial assets, for example, cash, receivables, okay, or net monetary assets, you don't apply IS 36, okay? You only apply IS 36 on tangible non-current assets, okay, and intangible assets like goodwill, okay? But when it comes to financial assets, you don't impair them based on IS 36. What do you use? You use IFRS 9, financial instruments under expected credit losses, okay? So even if this statement is not there, you will not impair this asset because the non-monetary is the net monetary asset, okay? So that's it. Although the examiner has helped us by saying it's going to be realized in full. It's like saying I have a 2,000 naira in the bank. My 2,000 naira will still be my 2,000 naira, okay? Even though inflation or devaluation might have affected it, okay? So, but you don't apply IS 36, you apply IFRS 9, okay? So that's it. And that's the end of that question. So you can see the solution there. Can you see? Okay, so this was the headings I was talking about the other time. So this is exactly the way you are going to do it. Okay, so when you do the proration, you know we have 28 left. So what do? You simply add 49 plus 35 plus 14. You should have 98 thereabout. So you now say 49 divided by 98 multiplied by 28. So it's going to give you this 14. Okay, 35 divided by 98 multiplied by 28. It's going to give you this 10. Okay, if you add this 14 plus 10 together, obviously 4 is remaining. So you now put the 4 here. So by the time you add this impairment together and you don't have 41, the original impairment loss, that means you are your own. That means your calculation is not correct. So one good thing about cash generating unit is anytime you do it, you will know whether you get it correctly or you get it wrongly. And obviously, if you remove this 41 plus from this 150, you are going to have the new kind amount to be 109,000. Okay, that's the end of IAS 36. So go through these questions. Okay, time will not permit us to go through them. So you have this night, tomorrow morning before we meet. Before we meet tomorrow again. So to go through these questions. Okay, but let me show you this one before I leave this area. Okay, they are very simple. Okay, just go through them. They are very simple. But let me check this C part of this question. Now here it said M incorporation as a single substantial asset, the CMIX which it uses to manufacture computer chips rather. Okay, the current amount of savings after 4 years is 5 million, cost 7 million, accumulated depreciation 2 million. Okay, there is no expected residual value due to breakthrough in technology in the manufacture of computer chips. M incorporation now expect the machine to produce 10% less in revenue terms than expected over the rest of the useful life of 10 years. Net future cash flows of the next 5 years based on management's best estimate after taking the 30% cut into account are as follows. So we're giving future cash flows up to 5 years. Now, they now said the expected growth rate in the following years are as follows. So from year 6, it's going to grow by 2%, 1% in year 7, blah, 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 like that. And I said, if the machine was not sold, now it will realize 3.2 million net of selling costs. The discount rate applied to the future cash flow is 10% required. Calculate the impairment loss and state the new kind amount of CMIX of CMIX. Okay, that's fine. Now, when I see this question, you don't need to run away. That's why I wanted to quickly show you. Okay, it's very simple. I've already determined that this is what's it called, impairment, right? Because they have given me value in use, which is the future cash flows information. They have also given me what's it called, fair value less cost to sell, right? So I needed to calculate impairment. That's what I want to do. So when you see this question, remember, it's the principle. I needed 2 things. What's number 1? I need carrying amount, and number 2, I need recoverable amount. And I ask this question, no matter how big the question is, just ask yourself those 2 questions. Then I ask the question, where is my carrying amount? It's going to tell me. It said the carrying amount is of savings after 4 years is 5 million. Can you see? It's going to tell me. If I even went ahead to tell me how it was calculated, it said the cost was 7 million and depreciation was 2 million. That's already calculated for me. So I have my carrying amount. Then I ask another question. Where is my recoverable amount, which is divided into my fair value less cost to sell and value in use? So I ask the question, where is my fair value less cost to sell? It's going to tell me. It said, if the machine was sold now, it will realize how much? Can you see? 3.2 million net of selling cost. That means they have incorporated the cost to sell inside it. So I have 3.2 million. That's it. It's as simple as that. I'll see my fair value less cost to sell. Then the last question is, where's my value in use? Okay. You now say the net future cash flows. Can you see now? The net future cash flows. It said the next. I will attend to your question very shortly. So let me deal with this. It said the net future cash flows for the next 5 years. Can you see now? future cash flow for the next 5 years. So it gave me all this figure, okay? And the discount rate is 10%. That's it. So what do? I will simply write, my number of year 1, year 2, year 3, year 4, year 5, 6, up to 10. I will now start putting this cash flow. So here I have 600, year 2, I have 660, year 3, I have 710, year 4, 755, year 5, I have 790. So when I get to year 6, what do? I will grow year 5's figure, which is this 770 by 2%. That's the meaning. It will be the figure for year 6. I will grow it by 2%. So if you are very good, you just say 790 multiplied by 1.02. Okay, it will give me 805.8. I'm trying to press my calculator from here. That's 806. So you can just approximate. Okay, so for my year 7, what do? If you notice, this year 7 is in negative. Okay, this year 7 is in negative. Okay, so that means I will also grow it by 1%, but that 1% I will now remove it. Okay, that because it's a negative. Okay, so what will I do? I will say 0.08, is it 0.86 that we got for the year 6, Abi? Okay, multiply by 1%, I'm going to get 0.86. I will now remove it from that figure. Okay, I will remove it. Okay, so because it's in negative. So the figure I got in year 7, I will also grow it by 7%, but I will remove that figure. Okay, so that's what I do. The solution is there for you to check. So by the time I do that, I will now discount by 10%. Okay, I will have a figure. I compare that figure with this 3.2. The higher of the two is my recoverable amount. I will now come and compare with this 5 million. Okay, once it's lower than the 5 million, obviously is an impairment. Okay, so can you see it here? Okay, that's exactly. Can you see? We just got this figure. So because the other ones are in negative, can you see? So that means it will be reducing. So by the time you do everything, then you have this figure. This is 4.2, and the cost to sell, if you remember, should be 3.2. Okay, so that means this is higher. I will now compare this 4.2 to 5 million. Okay, the difference is my impairment loss. This is a question on diploma in Ifrs, ACCA. Okay, it's a very dicey question because I'm pretty sure most students may not be able to deal with that because of this growing factor. Okay, but that's why I needed to quickly show you that it's very simple. Okay, so let me look at this question. Please, is there any basis for allocating impairment loss balance in the previous question? Is there any basis? Is there any basis? Yes, there's a basis. The basis is the procedure in I-36, right? Because we have obviously impaired assets, we have reduced goodwill to 0, so there is a balance, okay? And it is a cash generating unit. So the basis is that, or for prudency, you just have to allocate those balance or the balance you're having on other assets. That's the procedure in IAS 36 because it's a cash generating unit. Normally, the problem with cash generating unit is you may not really be able to separate them separately, or to value them separately unless you bring them together. Okay, that's if you can separate it, you can value them separately. That's pretty straightforward. Okay, you have to bring them together to know their value, their kind amount. Okay, so that's the whole idea. Okay, thank you. All right, so that's the end of what's it called, IS36. So you want to be sure we have done indications of impairment. If you remember, I also told you how to measure recoverable amounts, how to measure value in use, and your cash generating unit, and accounting treatment for impairment loss for an individual asset, and obviously cash generating unit. So that should be that's the end, right? Okay, so you have some classwork for you. Okay, so you can go through them. I think that one has answers, but some does not really have. Those are your practice questions. Okay, like this one. So you needed to practice them. Okay, if you're having difficulties, you can always get back to me. I'm going to assist you on them. Okay, now look at this question 3. I've explained it when we are doing that. It said, the coronavirus pandemic has led to economic crisis in recent times. So that's a risk. The asset may generate lower cash flows than expected. Okay, now this means that asset impairment should increasingly be common. However, some regulators have expressed concern or surprise about relatively low level of impairment losses recognized by many companies post-COVID-19. It's vital that companies adequately identify impaired assets and write down accordingly. Moreover, companies must disclose useful information about impairment and impairment reviews in their financial statement. Here, part of the question is saying, in accordance with I-36, impairment of assets, explain when a non-financial asset must be assessed for impairment. If you are listening to me properly, you should be able to deal with that question. Okay, you should be able to deal with that question. Okay, now B part of the question said, discuss how accounting for the impairment of non-financial assets could lead to earnings management. It's not written anywhere. You can't see it in any textbooks, but your understanding of the standards will make you to produce a fantastic answer around here. And I've explained it, okay? I've explained this as well. You're actually listening to what I said. Okay, so that's the end. So go through them. Okay, it's very simple. So let's quickly check this standard. Okay, IFRS 5, assets held for sale and discontinued operation. So because of COVID-19, because of the the revenue streams of some companies are being badly affected. Okay, so they may not be able to maintain certain assets, so they might decide to sell some assets. And normally, before you sell assets, you might need to, because you've not really sold it, okay, maybe at the end of the reporting period, you now need to classify it as held for sale, okay? So it could be as a result of COVID-19. It could also be as a result of the fact that you're trying to also manipulate your financial statements, okay? So I'll also show you how you can use IFRS 5 to manipulate your reported profit, okay? I'm not teaching you bad things, but you just need to understand so that when somebody do it as an auditor, we have auditor here, so they are auditing everything we are doing. So you can spot it immediately, okay? And even as a chartered accountant, you should be able to know how this works, right? Now, assets can only naturally, as per the standard, be classified as held for sale if its recoverable amount, if its kind amount can only be recovered through sale rather than continuing use, okay? Somebody is asking a question, please. How can we get the notes? It's on the platform already. Okay, it's on the platform already. Check, is on the class group. We created a WhatsApp platform. It's there already. Okay, if you cannot see, just chat me up. I'll send it back to you, right? So the note is there already. Okay, I sent it shortly before the class started. Okay, now an asset can only be classed as held for sale if its kind amount will only be recovered through sale rather than continue use. So what it means is, if the kind amount of an asset is 500,000, and I see that, I cannot realize this 500,000 if I continue to use it, the best thing is to sell it. And if I sell it now, I can get the money. Okay, that's the whole idea around classifying an asset as held for sale. Okay, now before an asset can be classified as held for sale, two conditions must be met, and you must take that to the bank, right? You must know it, because those are the conditions you need to check out for in questions for you to be able to solve them. Okay, so whether you're writing corporate reporting or you're writing financial reporting, this standard is very key. So that's why anytime I'm taking accounting standard, I will always start with IS36, then go to IFRS 5. Once you know those two standards properly, we won't struggle in every other standard. Okay, now we said two conditions must be met. Number one, the asset must be available for immediate sale in its present condition. And number two, the sale must be highly probable. Okay, so let me take that again. Before an asset can be classified as held for sale, two conditions must be met. Number one, the sale the asset must be available for immediate sale in its present condition. And number 2, the sale must be highly probable. Okay? Now, let me explain those two. When they say, what's it called? The asset must be available for immediate sale in its present condition. What does that mean? That means before I can sell my calculator, I don't require a repair that needed to be done. Okay? The calculator does not require a repair to be done. That means this calculator is in perfect condition. Now, remember, before an asset can be classed as held for sale, what it means is these two conditions must be met at the reporting date. So we'll be using reporting date December 2019. Okay, so that means I normally use the asset, in production or for PPE, that's production of goods or services or for administrative purpose. Okay, so because of COVID-19, okay, all of a sudden I don't really have money I needed to sell. Okay, so I now classified asset for sale. So those two conditions must be met. That means my calculator or my machinery or whatever must be available for immediate sale in its present condition. That means no repair work needed to be done. That is for you to understand. Now, you have spent sleepless nights to cram this condition. Okay, and you now get to the exam. The examiner now asks you, explain the concept of available for immediate sale in its present condition. And now say, this is what I've crammed, and the examiner is now putting it back to you that you should explain. So that's why I normally encourage you. You don't need to cram anything. Okay. Now, if the examiner should ask you, explain the concept of available for immediate sale in its present condition, then what do you tell the examiner? You simply tell the examiner by saying, when an asset is available for immediate sale in its present condition, it simply means the entity has control over the asset. That means they can prevent any other person or entity from gaining the same economic benefit from the asset. Okay, and there are no restrictions from selling the asset. That is the concept of available for immediate sale in its present condition. Can I say that again? It simply means the entity has control. Normally, if you don't have control over an asset, you can't even recognize it as an asset in the first place. Control simply, you can only demonstrate control if substantially all the economic benefit associated to that asset is going to flow to you. Okay, and normally there's no restrictions from selling those assets. You know that some assets, before you can sell them, you need permission, you need government approval and all of that. Okay, once there are no restrictions and there's no repair that needs to be carried out on the asset, then you can go ahead. And that means that's the concept of available for immediate sale. So why? We're going to find out shortly. Now, number 2, the sale must be highly probable. Okay, for this to be the case, 5 conditions must be met. Don't run away. It's very simple. I'll break it down, right? Okay. Now, so that's our number 2 conditions. For that to be the case, 5 conditions, must be met. Okay. Number 1, appropriate level of management must be committed to a plan to sell the asset. Number 2, an active program to locate a buyer must have been initiated. Number 3, the price offered for the asset must be reasonable in line with its fair value. Number 4, the sale is expected to occur within the next 1 year. And number 5, there is no plan to withdraw the assets from being sold. Once those 5 conditions are met, then you can go ahead. That's the meaning of the sale must be highly probable. So effectively, 7 conditions must be met before you can classify an asset as held for sale. So let me take a run again. Number 1, the asset must be available for immediate sale in its present condition. Number 2, the sale must be highly probable. For this to be the case, 1, appropriate level of management must be committed to a plan to sell the asset. So if you are an external auditor and you are auditing the financial statement or financial records of a particular company, and in the accounts, they have classified some assets as held for sale, then what do you need? You need evidence of these conditions that they have met them, okay? For example, appropriate level of management must be committed to a plan to sell the asset. So you determine who is the appropriate level of management. Normally in audit, they call them those charged with governance. It could be the management, maybe the senior management, it could be the board of directors. So you need evidence of board meeting, okay? Minute of board meeting, where it has been resolved that the asset should be classed as held for sale, okay? That's what they mean by appropriate level of management. An active program to locate a buyer must have been initiated. So what do you need around that area? Have they contacted lawyer or auctioneer, or have they advertised in the newspapers? Those are the evidence. There are reasons behind this standard. Okay, I'm going to show you shortly. Then number 3, the price offered for the asset must be reasonable, in line with its fair value. So the fair value of the asset is 5 million, and you want to sell it at 7 million. That means it's not reasonable. That's the meaning. Even though IFRS 5 did not tell us what is reasonable, but obviously you can use judgment, and materiality concept to know what reasonableness really means, okay? But for the exam purpose, if the fair value is 5 million and they want to sell at 5.5, even if it's 5.1, then it's not reasonable, okay, for your exams. But in practice, it might not really be the case, okay? So that's what the meaning of the price must be reasonable, in line with its fair value. And number 4, the asset is expected to be sold within the next 1 year. So what's the meaning? If I'm classifying the asset as held for sale in December 2019, what it means is by December 2020, the asset should have been sold. That's the meaning. That means in the next accounting year, okay? Because those 7 conditions must be met as at December 2019, okay? Now, the last one is the sale is expected to occur within the next 1 year, okay, or 12 months, okay? However, IFRS 5 went ahead to state that if the asset is not sold after 1 year, okay, and the reason why it was not sold, those that are subject to the conditions that are not within the control of the entity. IFRS 5 says the entity can continue to classify the asset as held for sale, provided those conditions are still met at the reporting date. Now, be with me here. If you meet 6 conditions out of the 7, you did not meet the last one, you cannot classify as held for sale. That means at a point in time or after the reporting period, you must meet those conditions. So you have to understand that. But for your exams, obviously the examiner cannot play around those 7, okay? Except they ask you, like in May 2019, was it May 2019 or November 2019 corporate reporting question? The examiner, it was the first question when they open their exam paper like this. The conditions to be held for an asset to be held for sale was part A of question 1, compulsory question. And in the class then, I think it was November 2019, if I'm correct, or May 2019, I was dancing in the class with this, what's it called, with this condition. You're just looking at me. So some of them say, they remember the way I was dancing and they were able to put it down, okay? So you just have to learn it, okay? So for your exams, except the examiner asks you to list or explain those conditions. But when they ask you in a scenario-based questions, obviously they cannot take you through the 7. So they can play around 2 or 3 of them. So the question is, you have to find out whether those conditions they are playing around, whether those conditions have actually been met before those can be classified as held for sale. Now, be with me here. Be with me here. We're going to look at some questions now to demonstrate this before we now go to measurement. And that's the end of IFRS 5. Then we look at this other one, that's discontinued operations. It's very simple and it's very straightforward. But be with me here. Whenever an asset has met the criteria as being held for sale, that means it has now been classified as held for sale. 3 things must happen. Be with me, it's in your note, it's somewhere in your note, okay? 3 things must happen. Let me say that again. Those are the principles you need to understand. And when you pick up financial statements, in fact, at your level, okay, you should be able to ascribe some meaning to it. Okay, I remember 2 years ago, I pick up my company's financial statement, I think 2018 financial account, 2018. So that was last year, yeah. I pick it up and I start to look at it. You know, it makes a lot of meaning to me. Why? Because I understood accounting standards, okay? Once an asset has met the condition and has been classified as held for sale, three things must happen. Number one, they must be represented separately on the face of the financial statement. What does that supposed to mean? That means when you are preparing your financial account, you will say asset held for sale. Remember, I'm using this asset as one of my PPE before. You know, I have so, you know, what you have as PPE, there are so many assets. That's why they call it property, plant, and equipment. So one of them or two of them has now been classified as held for sale. That means I will remove it from my PPE that is under my non-current asset, and I will take it under my current asset because we say it has to be sold within the next 1 year. I will now call it what's it called? Asset held for sale. Okay, I will call it asset held for sale. Okay, that's it. So it has to be represented separately on the face of the financial statement. Another standard that has to be represented separately on the face of the financial statement is IS 41, agriculture. You call it biological assets, but we're not taking that now. You just have to, you know, branch there, okay? So it has to be represented separately on the face of the financial statement. Number two, asset held for sale are subject to annual impairment review. Remember, under IS 36, we said an entity can only test for impairment if there are indicators of impairment, which could be internal indicators or external indicators, if you remember. However, we said there are 5 classes of assets that must undergo impairment review, whether or not there are indicators of impairment, okay? Number one, we said goodwill acquired in business combination. Number two, indefinite assets. Intangible assets with indefinite useful life. And number three, assets classified as held for sale. Can you remember? And number four, asset bought with a view to resell. And number five, intangible assets during their development stage. Okay, so that's what you are seeing here again. Can you see the interconnectivity among accounting standards? Okay, so once asset has been held for sale, they are subject to annual impairment review. And number three that you must know, assets held for sale are no longer depreciated. Assets held for sale are no longer depreciated. Let me run it again. Three things that must happen. Once an asset has made the criteria has been classified as held for sale, they are represented separately on the face of the financial statements. They are subject to annual impairment review and they are no longer depreciated. So in case the examiner should hang you or ask you that because of COVID-19 pandemic, a lot of companies are pressured to classify assets as held for sale. Then your requirement, the examiner now says, explain how entity can use IFRS 5 to manipulate reported earnings. That's it, or for earnings management. So what do you tell the examiner? Because assets held for sale are no longer depreciated, and when I don't depreciate, what happens to my profit figure for the year? It will go up because I don't charge depreciation again. So because I want to manipulate my reported profit, because I want it to go higher, I can decide to classify certain assets as held for sale. And after 1 year or 2 years, I write them back, okay? So that I can, you know, improve on my reported profit. Can you see understanding? Once you understand all those principles, then you are fine, okay? So let's look at 1 or 2 questions to demonstrate that. Now, exercise 1 is said, on 1st December 2023, a company became committed to a plan to sell a manufacturing facility and has already found a potential buyer. The company does not intend to discontinue the operations currently carried out in the facility. At 31 December 2023, there's a backlog of uncompleted customer orders. The company will not be able to transfer the facility to the buyer until after it ceases to operate the facility and has eliminated the backlog of uncompleted customer orders. This is not expected to occur until spring 20x4. Required. Can the manufacturing facility be classified as held for sale as at December 31, 20x3? When I see a question like this, I already know that this is IFRS 5. Then I remember my conditions in my head. There are 7 of them. But obviously, the examiner will not play around those 7. So what is the examiner really playing around here? He said on 1st January 20X1, plan to sell a manufacturing facility. Can you see? They became committed. And even because of that, they have even found a potential buyer. They met 2 conditions. Can you see? One of them is an appropriate level of management is committed to a plan to sell the asset, and an active program to locate a buyer must have been initiated. Can you see? They met that condition. Okay, they now go ahead by saying the company does not intend to discontinue operation carried out in the facility. And as at December 31, that's the end of the year. Don't forget, when you are dealing with accounting, date is very important. Okay, you have to watch out for the date. If you see the requirement again, it said, can the asset be classified as held for sale as at the end of the reporting period, which is 31st December? And we have established that before you can classify an asset as held for sale, December 2023, all the conditions must be met. Okay, all the conditions must be met. Okay. Let me see. There's a comment here. Please note that the date should be January. Okay, January. I don't understand that. Can you elaborate on that so that I can explain, or I can explain? Okay. So now, it now said, now the company does not intend to discontinue the operation. Now said at 31st December 2023, there is a backlog of uncompleted customer orders. Can you see? Now, it now said the company will not be able to transfer the facility to the buyer until after they cease to operate, and this is not expected to occur until spring 20X4. Okay, until spring 20X4. Okay, let me see. Please note the date should be in January. Question 1. Question on December 1. Okay, or question on December 1. Okay, it should be. No, it's actually correct. Okay, I think I understand what you're saying. I think you are referring to this date, right? On 1st December 20X3. It's correct. That's the beginning of the month. Okay, they became committed, right? They became committed. It's actually correct. So because you can decide to sell at any time during the reporting period, it doesn't have to do, it's not compulsory, it's January. Okay, but for the exam purpose, if it has to do with the cost of an asset, it can be 1st January. Normally you can buy asset anytime. Okay, so but because exam questions are padded, that's why most likely they will say 1st January. But if you write ACCA, you see an asset being bought at the middle of the year. That means the depreciation for that year we have to be prorated. Okay, so it's actually correct. So that's at the beginning of the month. So it's not really compulsory. It's 1st January. Okay, now they became committed because I can decide. I can hold board meeting anytime during the year to say we want to sell a particular asset. That is not really compulsory. It has to be 1st January. Okay, so thank you for that. All right, so now, even though they have met those 2 conditions, like they were committed on 1st December 2023, they have also found a potential buyer. But there is a problem. Then they are not ready to discontinue the operation because they were backlog. Okay, and they can only transfer the facility, in 20X4, spring 20X4. That's by the middle of next year. Okay, so that means the asset is not available for immediate sale in its present condition. Why? Because of the backlog. That's it. So when you now look at the requirement, it said, can the manufacturing facility be classified as held for sale? So you tell the examiner, no. Your answer is no, right? Just say no. Okay, and you move out of the exam hall and now say, I have keyed ACCA or ICANN. You're on your own, right? So you cannot just say no. So you needed to explain, right? Okay, so what do you do here? I normally have a kind of principle or guide that you use here. So if I were you want to tackle this kind of question, now first thing, state the requirements of the standard. Okay, state the requirements of the standard. The second thing you do, relate that standard with the scenario in the question, okay? And third thing, you conclude with your answer. That's the best way to approach the question. So if I want to answer this kind of question, I'll just tell the examiner by saying, as per Ifrs 5, asset can only be classified as held for sale if they are available for immediate sale in its present condition. That's the principle. You just state the principle. You don't need to list all the 7, okay? Because it's a scenario-based question. You now said, based on this scenario, even though the entity became committed and they have already found a potential buyer, however, the sale cannot be carried out, or because what's it called? There are so many backlogs, operation cannot be discontinued until summer or until spring in 2024. This means that the asset is not available for immediate sale in its present condition. Therefore, the manufacturing facility cannot be classified as held for sale. You have your top mark, okay? You have your maximum mark around that area. So you can see the answer there. You go through it at your leisure, okay? So let's look at exercise 2 so we can move on. You should be able to do exercise 2, so don't let me waste time on that, but I'm interested in exercise 3. So let's see. You said ISOB is preparing its financial statement for the year ended 31st December 20x7, okay? On 1st December 20x7, the entity became committed to a plan to sell a surplus facility of office property and has already found a potential buyer. On 15th December 20x7, a survey was carried out, okay? And it was discovered that the building had a dry rot and substantial remedial work would be necessary. The buyer is prepared to wait. Can you see? The buyer is prepared to wait for the work to be carried out, but the property will not be sold until the problem has been rectified. This is not expected to occur until summer 20x8. Required. Can the property be classified as held for sale? So when I say this question, you don't start thinking, hey, can it be classified? No. Look at the principle. Relate the principle with the scenario, okay? Then I ask myself, what are they saying here? He said on 1st January, they became committed. Can you see? To sell. Okay, they met that condition. And even the question further states that they have found a potential buyer. That's fantastic. Now, on 15th December, they now carried out a survey. They now discovered that the building had a dry rot and substantial work will be necessary. Can you see? Substantial work will be necessary. Now, so based on that, what it simply means is the asset is not available for immediate sale in its present condition. Now, but the examiner wants to confuse us. He said the buyer is prepared to wait for the work to be carried out, but the property will not be sold until the problem is rectified. So don't be carried away by that statement, because the standard did not tell us that once the buyer is ready to wait, even though if the asset has substantial remedial work to be carried out on it, that it can be classified as held for sale. No. Do you get the point? The standard did not tell us that. So this is just a distraction. So the fact that the buyer is ready to wait is none of my business. The issue is it available for immediate sale in its present condition? So once the answer is no, obviously you cannot classify it as held for sale. So that's it. Now let's look at the part B of that question. It said a subsidiary entity B is for sale for 3 million, and they have found some interest from prospective buyer, but no sales as of yet. One of the buyer made offer for 2 million. Okay, so one person wants to buy it for 2 million. Now we are offering it at 3 million. That's fantastic. Okay, the directors have just received an advice that the fair value is actually 2.5 million. Okay, so they have decided not to reduce the sale of price of B at the moment required. Can subsidiary be classified as held for sale? Okay, so I check out what are they testing here. They're actually testing the fair value. We said the price offered for the asset must be reasonable, in line with its fair value. So if the fair value is 2.5 and we are offering at 3 million and we are not ready to reduce, that means we cannot classify it as held for sale. Okay, so that will be your answer after stating the principle, relating it to the scenario, and you make conclusion. Okay, so you can see the answer there. Okay, so that's it. That's it when it comes to the criteria that must be met before an asset can be classified as held for sale. Okay, don't forget I made mention that the fact that entities can also be pressured because of COVID-19 pandemic. So these are the standards that comes to the mind of the examiner. Okay, even in practice, these are the standards because a lot of companies are selling off their assets. Okay, so the issue is, do they meet those criteria? Okay, because they needed money, liquidity issues, right? Now, how do you now measure assets classed as held for sale after those conditions has been met? Okay, after those conditions has been met, at what amount? When you talk about measurement, at what amount will I use to recognize an asset? So this brings something to my mind. Okay, you cannot see it anywhere. But what I just mentioned now, I remember. Anytime you see a standard, okay, think of four things. Okay, whenever you see a standard, any accounting standard, IFRS, IAS, think of four things. It's not written anywhere, but these are the benefits of when you attend classes, and these are the things you have to get. Number one, technical definition. Okay, technical definition. I'm trying to write them down. Yeah, because it's just flowing to my head now. Okay, you think of technical definition. Every standard has a technical definition. If you go under conceptual framework, there are technical definitions ascribed to assets, liability, income, revenue, and expenses. Okay, even if you notice from I-36, we have checked those technical definitions. Remember, we define impairment, we define what's it called? Depreciation, we define fair value, recoverable amount, and all of that. That's what we call technical definition. Number two, that you need to look out for whenever you see a standard is the recognition criteria. Okay, recognition criteria. Okay, so before I can recognize an asset, what are the recognition bases? Okay, it is always there under conceptual framework. It's going to tell you that three conditions must be met before I can recognize an asset. Okay, number one, the item must meet the definition of an asset. Number two, it must be probable that future economic benefit will flow to the entity. And number three, the cost of the asset can be measured reliably. That's an example of recognition criteria. And like you just seen under IFRS 5 again, before I can classify an asset as held for sale, 7 conditions must be met. Okay, so that's what I mean by recognition criteria. Okay, and number three that you must take note of is a measurement criteria. Okay, measurement. So anytime you see the word measurement, it simply means value. At what amount? Okay, that's the meaning. It simply means value. Just like the impairment loss and the likes that we just said, that's the measurement criteria. At what amount will I recognize the asset or liability or income or expenses? That's what we mean by measurement criteria. And the last one that you think of whenever you look at standards is the disclosure requirements, or sometimes they call it presentation. Okay, but let's call it disclosure requirements. Okay, so what are the information I needed to disclose whenever I deal with any of these accounting standards? That's what we mean by disclosure requirement. Okay, that's what we mean by disclosure requirement. What are the things I needed to disclose? Okay, now for your exams, if you're writing ACCA or you're writing ICANN exams, the examiner is working around 2 out of these 3. They are working around 2 out of these 3. Even one of them, you needed those information. You need an idea or a background information about one of them, but you may not really see it in your exams. But you needed to have information about them because it's going to help you, in answering questions around the 2. The 2 important things out of the 4 I've just mentioned. We mentioned technical definition, recognition criteria, measurement criteria, and disclosure requirement. Okay, so when you are reading, bother about 2. Number 1, bother about recognition criteria. That is what the examiner is playing around. Bother about measurement criteria. That's what they are playing around. These are the 2 things. Go and check them 20, 50 years diet. that they have been testing. These are the two things that the examiner is playing around. You know, when you understand all these things, you don't struggle again, okay? Especially in your study, even in practice. That's what you are more bothered about, okay? But in practice, it's more than that. In practice, you might need to know disclosure requirements, especially when your company is a public company. You needed to submit report to SEC, to Nigerian Stock Exchange, to CAC, as the case may be, or to CBN. So they want to see disclosure requirement, okay? But for your exams, you need those two things. But you might need to also know technical definition, because it's going to help you, okay? I've seen in a corporate reporting exam before, the examiner says, according to Ifrs 13, divine fair value measurement. That is technical definition, 2 marks. So sometimes the examiner might decide to bother you around technical definition, but it's not really common. But everything you are doing, right from first question to the last question, borders, once it comes to standard, centers around recognition criteria and measurement criteria. So I just remember that. I said, let me quickly chip in that, okay? So when we now come to asset held for sale, and we said measurement criteria, that means I have met the recognition criteria. Then how do I measure? It has to be measured at the lower of their carrying amount and fair value less cost to sell. Can you see? This is another national anthem that I'm giving you tonight, okay? I think we have about 4 of them now, B5, okay? That must be in your head, okay? So it has to be measured at the lower of their carrying amount and fair value less cost to sell, okay? Under IS 36, you have to measure your recoverable amount at the higher of fair value less cost to sell and value in use. Can you see that? But when you come to IFRS 5, you know, the measurement criteria, how much? I have to measure it at the lower of the carrying amount and fair value less cost to sell. So let me put some figures around that so that you can understand. So it's my carrying amount. Everybody knows how to do carrying amount now, right? My carrying amount is 500,000. Okay, and the asset has now met the criteria of being held for sale. Okay, I will have to estimate the fair value less cost to sell. That means if I decide to sell the asset, you know, I'm not even using it again. So that's why I don't have business with value in use. Okay, I want to sell. Okay, so that's it. That's the idea. You can't see that written anywhere. But I think that's the idea around the standard, okay? So sometimes I try to explain reasons why those standards were like that, okay? And that boils down to understanding, okay? So I will estimate the fair value less cost to sell. So everybody is familiar with that, Abi? Okay, so if my carrying amount is 500,000 and the fair value less cost to sell is, let's say, 300,000. So which one is the lower? Obviously, is the fair value less cost to sell. So I will have to write the asset down from 500,000 to 300,000. Okay, so there's a problem there, right? There's a problem, right? The carrying amount is higher than the fair value less cost to sell by 200,000. I will now take the 200,000 as impairment loss. I will take it to profit or loss account. That's it. Can you see now? You see the way I-36 is even coming in in IFRS 5. Okay, we are not going to do borrowing costs as 23, but that's a way impairment is also featuring in IFRS 23 borrowing costs, right? Okay, so that's why you need to understand, right? Okay, so when the carrying amount is 500 within PPE, okay, you know, I normally carry it as PPE, and I want to take it as one of my current assets as asset held for sale. So I have to estimate the fair value less cost to sell. Once it's higher, I write it down. The difference is impairment loss. But if my carrying amount is 500,000 and fair value less cost to sell is 800,000, I will continue to carry it at 500,000. Simply means the asset is not impaired, so I ignore the difference. Okay, so that's it. That's it. Okay, so let's move on. Okay, I've explained all of that. Okay, so everything I've said, I've explained them here. It's there. So let's look at this question now. Okay, so he said on 1st January 2021, Mitchell Co. bought a chicken processing machine for 20,000 and it has an expected useful life of 10 years and a near residual value. On 30th September 2023, Mitchell Co. decided to sell the machine and start actions to locate a buyer. The machine is in short supply, So Micheko is confident that the machine will be sold fairly quickly. Its market value as at 30th September 2023 is 13,500, and it will cost 500 naira to dismantle the machine and make it available to the purchaser. Now the machine has not been sold at the end. Required at what value? Can you see? Should the machine be stated in Micheko statement of financial position as on December 31, 2013? I've told you date is very important. So I like this kind of question. The requirement, the examiner did not tell me according to Ifrs 5, according to IS 40, according to what's it called? IS 2, okay. Sorry. So sorry, let me take some water. I've not taken water since 7. Oh. Sorry, and I have water here. I didn't take, and you didn't come and eat. All of you are eating. Abi, you have been eating since. Okay, now, so how will I know the standard has been tested here? So when I go back to the question, it said on 1st January 2021, Micheko bought a planting at 20,000, the expected useful life of 10 years with the new residual value. This does not tell me that they are testing IFRS 5. Okay, it could be IS 16, it could even be any other standard. Okay, they don't really tell. It said processing machine, so it cannot be IS 40 because IS 40 has to deals with land or building. Okay, now I now said on 30th September 2007, Micheko decide to sell. Can you see? They decide to sell. So the only standard that talks about selling when it comes to non-current assets is IFRS 5, and they have even started action to locate a buyer. So that solidify, the fact that this is IFRS 5. So it's now asking me at what value, okay? And they will also tell me when they want me to calculate up to. So it said December 31, 20 X3. So that's key. Now, when I know, since I've already known that this is IFRS 5, and in talking about measurement, it's assumed that they have made a criteria. So I don't bother about that because it said they decide to sell, actions to locate a buyer are started. So I don't bother myself about other conditions because the examiner is, more particular about the value, which is a measurement criteria, okay, or measurement basis. Now I needed 2 things. No matter how big that question is, I've told you, it's just a principle. So I needed 2 things. I need information about my carrying amount, and I need information about fair value less cost to sell. That is it. It's as simple as that. Because I needed to measure asset held for sale at the lower of their carrying amount and fair value less cost to sell. Then I ask the question, where is my carrying amount? It's going to say yes, this is where I am, or it says no. Okay, so when I look at the question, the examiner did not mention carrying amount. Then I ask again, if he did not give me carrying amount, that means I needed to calculate it. And remember, we said under IS 36, when I was explaining carrying amount, we said carrying amount is the amount at which an asset is recognized on the financial statement after deducting accumulated depreciation and accumulated impairment losses. Then I ask a question, since you did not give me carrying amount, where is my cost? That means you want me to calculate. So where's my cost? It's going to tell me. It said on 1st January. So I've told you, date is very important. So in your when you are dealing with questions like this, always be mindful of the date. It said on 1st January 2021, the Micheko bought. Sometimes you can say purchase, or the cost is this. So I don't need the soothsayer to tell me that 20,000 is the cost. Oh, that's fantastic. So I've gotten the 20,000. So in my note, I write Micheko. I will say cost 1st January 2021, 20,000. Then where's my depreciation? It will not give me, but it will give me information that I needed to calculate my depreciation. Okay. So, and one of them is the cost. I already have that. Then second one is the scrap value. Can you remember cost minus scrap value over number of years? So here it said it has a new residual value. Sometimes the examiner can be silent about the residual value, so you don't really bother. If they give you the figures around that, that's fantastic. So it already told me they have it. Oh, that's fantastic. So that means I will say cost minus 20,000 minus 0. That's the meaning, because I don't have residual value. Then what is the expected useful life or the number of years? It's going to tell me there's no way. The examiner will always give this there. So he said it's 10. Oh, that's fantastic. So I will say 20,000 divided by 10. Okay, that should give me 2,000. Okay, so when it gives me 2,000, that is my depreciation for 1 year. Okay, depreciation per year. Okay, then when did we classify as held for sale? Because we said once an asset has been classed as held for sale, depreciation will stop. Can you remember? So that's why you needed to know the principle. That's why I spent about 3 minutes there about around that area, trying to explain those 3 things that must happen once an asset has been classified as held for sale. If you remember, so depreciation will cease. So when did they, class the asset as held for sale? It said on 30th September 20x3, Micheko decide to sell. Okay, so it is assumed that at this date, that was when the criteria was met. That means depreciation will stop at that date. So how do I now calculate my depreciation? It's 2,000 for 1 year. Okay, so that means, and when did I buy it? The asset was bought 1st January 20x1. So what it means is this: I will depreciate in December 20x1. I've explained why we depreciate for you. Remember. So that means from January to December, because my accounting year is January to December. Okay, so my accounting year can be October to September. So you have to be mindful of those dates. So if it's January to December, I will depreciate in year 1, which is December 20x1. I will always tell my students that whenever you are dealing with questions like this, use your fingers to calculate. Okay, use your fingers. If you don't want to use your fingers, you can go with carry or what's it called? What do you call it? Go with carry or coins into the exam hall and say year 1, year 2. Okay, I'm serious. Because once you miss that date, it will affect all your figures. Even though you might get the principles correctly, but it would have affected your figures and you're writing incorrect figures in the exams. Okay, so use your fingers or carry or whatever so that you are appropriate. Okay, you are accurate. Okay, now I will depreciate for December 20x1. I will depreciate for December 20x2. Okay, but when I get to when I get to 20x3, I cannot depreciate for the whole year. Why? Because it said on 30th September 20x3 they decide to sell. So that's when they met the criteria. So that means depreciation will stop at that year, at that date. Okay, so for 20x3, I will only depreciate for 9 months. How did I get 9 months? January, February, March, April, May, June, July, August, September. Okay, that is 9 months because it is September 30th. The examiner has said September 1. That means it is 8 months. Okay, I will stop. August 31 and September 1 is the same thing. Okay, so that means I will do 8 months, but because they have said September 30th, so that means I will, include September. So that's how we have 9 months. I'll now say 9 divided by 12 multiplied by the 2,000. It will give me 1,500. Okay, so that means for 20x3, I will depreciate for 1,500. So 2,000, 1,500. That should be 5,500, right? I will remove it from the 20,000. Okay, it's going to give me 14,500. So that's my carrying amount. So whenever you say a question, the examiner already calculated carrying amount, it's really doing you good. But when you needed to calculate it, that's what you do. So I've gotten my figure for carrying amount. Then I ask the question again: where is my where's my fair value less cost to sell? It's going to give me, it said 13,500 is my fair value and cost to dismantle is 500. So when I do the summation here, what do I have? I have 13,000. Okay, so between 13,000 and 14,500, which one is lower? Obviously it's 13,000. I will now write the asset down from 14,500 to 13,000. Okay, I have difference of 1,500. So where do I take the 1,500 to? My profit or loss account. That's it, as an impairment loss. Okay, so that's what we just did here. Okay, it's very simple and straightforward. So you can practice exercise 5. It's also very straightforward. Okay, if you're having issues there, you have solutions there, so you can let me know. So let's quickly deal with the other aspect. That is discontinued operations. Okay, discontinued. We said the standard is IFRS 5, asset held for sale and discontinued operation. So what is a discontinued operation? It's a component of an entity that has either been disposed of or is classified as held for sale. Okay, that has either been disposed of or is classified as held for sale. Okay, now let me just explain like this. ShopRite. I think I think last week, was it this week or last week, they said they are leaving Nigeria. Okay, they are in their financial account, they classify Nigeria subsidiary or retail outlet as a discontinued operation. That's a very classical example. Okay, or look at KFC. You have KFC in Ikeja, you have another one in Lekki, Ikorodu, and all of that. So you decide to stop one of those outlets. That's a discontinued operations. Okay, and it's defined as a component of an entity that has either been disposed of, that means we have sold it during the year, or is classified as held for sale. That means it has to represent a separate major line of business, just like ShopRite. ShopRite is one of the separate major line of business or geographical area of operation. So some companies, they classify some of their operations, by geographical area. For example, you see Samsung West Africa, Samsung Central Africa. That's the way they do that, okay? Or it's part of a single coordinated plan to dispose of a separate major line of business or geographical operation. Maybe you have a plan to dispose, or it's a subsidiary acquired exclusively with a view to resell, okay? That's a discontinued operation. For people writing corporate reporting, don't expect the examiner to ask you what's the discontinued operations, but for financial reporting, obviously, they can ask you, okay? Now, what are the conditions that must be met before you can classify a discontinued operation as discontinued operation, okay? It's the same thing. That's the good news. The good news is that it's the same thing. We have learned it earlier on. The asset must be available for immediacy in the present condition. Can you remember? It's the same thing with discontinued operation. So all you need to be doing is the operation must be available. Instead of using asset, just say the operation must be available for immediate sale in its present condition, and the sale must be highly probable. For this to be the sale, appropriate level of management must be committed to a plan to sell the operation, something so that you just replace the asset with discontinued operation. So let's now look at this question to demonstrate our understanding around this area. Okay, now be with me here. I'll just use this question to demonstrate this, and that's the end of IFRS 5. It's an operation, just like ShopRite, like we said. They are earning, they are bringing, what's it called? Is it revenue now? Yeah, for the company. Okay, so because it represents separate major line of business. So your company too, you can have some separate major line of business. Okay, you are doing airline, for example. Airline operations is an operation. Okay, you are also into airline services. Okay, you are providing services. Let's say ground handling. Okay, you are doing ground handling services in line, plus your airline operation. Airline operation has to do with airlifting of passengers, selling tickets. Okay, you are doing ground services. You're also doing ground handling services that involves passengers disembarking, ground cooling, and all of that. Okay, and you also have another one that is called catering services. Okay, so you have 3 separate major line of business, and all of them, they are bringing on revenue in your consolidated account. Okay, so you now decide to stop the catering. Okay, so that's it. That's a discontinued operation. So the examiner can bring you on that. Why is it necessary to disclose information about a discontinued operation in the financial statement? I think I put up a question like that up in your note. Okay, so we're going to find out why. So let's quickly look at this question, and probably we call it a day from here. I actually intend to take you I extend, but obviously time is not on our side. So being the first day, we're going to stop after this question. Let's see. But tomorrow, we are not wasting time at all. Okay. Now, the Portugal group of companies has a financial year end of 30th June 2024. So that's very important. Okay. Now, the financial statements were authorized 3 months later. The group is disposing of many of its subsidiaries, each of which is a separate major line of business or geographical area. So he said one of them is a subsidiary in England, was sold 1st January 2024. On January 1, 2024, an announcement was made that there were advanced negotiations to sell subsidiary in Switzerland and are subject to regulatory approval. This is expected to be completed by 1st October 20x4. The board has also decided to sell a subsidiary called France. Agent has been appointed to find a suitable buyer, but none have yet emerged. The agent advises that the potential buyers are deterred by the expected price that Portugal hopes to achieve. And on 10th July 2024, an announcement was made that another subsidiary, Croatia, was for sale. It was sold on 10th September 20x4. Required, explain whether each of these subsidiaries meet the definition of a discontinued operations as defined by Ifrs 5. Oh, okay. So when is my accounting year end? He said 30th June 20x4. So that means the beginning of this year will be 1st July, Abby, 20x3. Okay. So obviously it's an necessary question. Okay, I can we never give you something like it will always be January to December. Okay, now so it's first so we established that, right? Now, and they said they didn't meet the definition of IFRS 5, and the definition is discontinued operation is a component of an entity that has either been disposed of or is classified as held for sale, and you know the conditions to be classified as held for sale. So when you now look at this first one, it said a subsidiary in England was sold on 1st January 20x4. Oh, that's fantastic. Okay, so if my accounting year is 1st July 20x3 to 30th June 20x4, then subsidiary England was sold 1st January 20x4. That means it was sold during the year. So when I'm preparing my account on 30th June 20x4, how will I class subsidiary England? I will class it as discontinued operations. Why? Because it has been sold during the year. Can you see now? I cannot take it as a continued operation again. So in my income statement, I will just say revenue or income from a discontinued operations. Okay, so because it has been sold during the year. Now, second one is said on 1st January 20x4, an announcement was made. 1st January 20x4, that same date that England was sold, that there were advanced negotiations to sell subsidiary England, Switzerland rather, and subject to regulatory approval, the sale is expected to be completed by 31st October 20x4. Okay, so when they made announcements and there were advanced negotiations, so what does that mean? It simply means that, you know, when you say advanced negotiation, that means they have found a buyer, they have agreed on the price, and the buyer is ready to pay. Okay, but the clause they were given is subject to regulatory approval, and this is expected to be completed. Don't forget the discontinued operations, right? And it will be completed by October. That means even before the next 12 months. Okay, so because of this advanced negotiation, it means they have found a buyer. The buyer has agreed to the terms and conditions just for them to, you know, sell. Okay, so they can class it as a discontinued operations. Okay, now the third one is saying the board has also decided to sell subsidiary called France, and agent has been appointed to find a buyer, but not as emerged. Why? He said the agent advised that the potential buyers were deterred by the expected price. So most likely, the price offered for this discontinued operation is not reasonable in line with its fair value. So they cannot, it does not meet the definition of IFRS 5. Okay, so they cannot class it as discontinued operation because agents, buyers are deterred by the price value placed on that. Okay, now the last one here said on 10 July 20x4, an announcement was made that another subsidiary, Croatia, was for sale. It was sold on 10 September 20x4. Now, be with me here. Look at here. They said on 10th July. Okay. Now, this 10th July is after the year end. You know, our year end is 30th June 20x4. And the conditions must be met as at that date. Okay. But on 10 July, they made an announcement. and it was sold 10 September 20x4. So this is not within the scope of IFRS 5. It's within the scope of another standard, which is IAS 10, events after the reporting period. Okay, so obviously, when I'm preparing my account 30th June, I cannot classify Croatia as a discontinued operation. But because it was after the year end, then I will now look at IAS 10 events after the reporting period. So the question now is, will I classify Croatia as an adjusting event or as a non-adjusting event? We're going to find out tomorrow, so let me release it for today, but tomorrow be prepared that the class might be extended to 10:30, 11, so that we can cover what we have. Okay, so we'll be starting immediately with IS 10 event after the reporting period. Is also one of the standards that came to the spotlight because of COVID-19 pandemic. So there were concerns, in January when COVID, caught over the world, that if COVID-19 should be treated as an adjusting event or non-adjusting event. So there is a consensus by the IASB, the IFAC, and all of that. So what did they agree on? We're going to find out tomorrow. Okay, so thank you for your time. My host, I'm guessing you are ready for the closing remark before we close today's class. Okay, this is the question I was asking the other time. Why is disclosure of discontinued operations important to users of financial statements? Okay, so we said the whole idea is that the users of financial statements can do proper assessment of the future cash flows. When they have those information, they can do proper assessment of the future cash flow. That means that particular operation will not form part of the future cash flows. That's why it's important. Even the expenses and all of that, it would have been eliminated. Okay, so for you guys writing exams, you might need to consider that. Okay, thank you so very much. You have some practice questions that you can do from there. Okay, so obviously tomorrow, by God's grace, we are going to start with ISS. So in case you have questions, put it up on the chat. If no question can come to your mind as we speak, you have my number. You can chat up or on the group. You can also feel free to ask your questions. So I want to believe you enjoy the class. Okay, I want to believe you enjoy the class. So let me hand over to my host to make some closing remarks before we close finally. Thank you very much once again. So my host, over to you.
Okay, thank you so much, Mr. Ayomi, for that fine, well-researched, well-delivered discourse on IFRS. In fact, while listening to you, I wish I am writing this exam again, because you brought out some salient points that really made sense. Thank you so much for the time you spent in bringing out this well-researched paper. And all our participants, I say thank you too for your patience in these past 3 hours. It's not easy for you to listen, sit down one place and listen from 7 o'clock down to 10 o'clock. I believe some of us would have been eating and our facilitator was busy talking all through 3 hours. Some of you might have been sitting down waiting to see the end before you eat your dinner. Very soon we'll release you that you are all August. This is our August meeting. So the final part of this program, I call it the bottom part. You will be thrilled very, very much, just the way you enjoyed it. So we'll crave your indulgence that tomorrow, if possible, we might extend up to 10:30 or more. So come prepared to stay longer. If you have any question that you think have not been answered from this part of the delivery or from everything, feel free to put your questions in the WhatsApp forum. You know, sometimes because of network issues, we might not see your questions as at now, but if your questions have not been answered, put it in the WhatsApp forum and you can be sure that the facilitator will see it and respond to it. If not today, he might put it in his comments tomorrow. So thank you so much, all of you, for your fine attendance. I wish I could see your face to see how happy you are. And some of us who are writing the exams, I know that this will be a good boost, gingering you up, and you'll be wanting this part of the question to come so that you can just demolish it. Okay, so we promise we will not keep you longer. We want to release you now. So we'll say thank you and goodbye. Sleep well. Tomorrow, some of us will be going to service, right? Because the lockdown has been eased off now, so you can go to service. So let me not keep you waiting. Let me allow you go to bed. Till tomorrow when we come your way again, keep expecting, keep studying, and don't drop your book. All right? And always also follow all of our First Choice Academy accurate in all our social media platforms. We'll be posting on our social media platform in the group chat right about after the end of this webinar so that you can follow us and also get some notification about some of these things that we'll be bringing to you. So once again, thank you so much and good night.